everyone. Thank you all for making your time out on a Saturday afternoon and coming to meet us. Also, our online viewers to taking time out to listen to us. Very grateful to that. So before I start, I'll just introduce who's in the auditorium and on the panel today. So first off, we have our CIO, Mr. Rajeev Thakkar. Next to him, we have our three fund managers, Ronak, Raj, and Rukun. So famously, they're called the 4 Rs. So along with the 4 Rs, you have the pleasure of two Neils today. One Neil is Neil Borate, who you all would be knowing. He's the deputy editor of Mint. First of all, Neil, just want to really thank you to moderate this session and really appreciate it, you taking time out and coming here and spending your afternoon with us. Thank you. And I'm Neil Parikh, the CEO of PPFAS. Uh, thank you. Thank you. So this is the ninth year we are having our AGMs, and when we started the mutual fund 9 years back, one of the things we said, and we thought which would be really useful, was that having a two-way communication, having this AGM where we can interact with investors, with partners, and more than that, they can ask us any questions that they have, because if we are dealing with your money, and you put your trust in us, then it's your duty to ask us any questions you all might have about what is happening with your money. So that is exactly why we have such meetings. um, can I just get the presentation on one? So, before I start, I just need to read this out. Viewers should note that the objective of this meeting is to communicate with our unit holders and share with them our thought process. It should be noted that views expressed here are based on information available in public domain at this moment. Views expressed here can change depending on change in circumstances. Nothing discussed here constitutes a buy, sell, hold recommendation, and mutual fund investments are subject to market risk. Read all scheme related documents carefully. So while we have that out of the way, I just wanted to so I'll just tell you how this will work. So I guess I'll give a presentation in the beginning. Again, my presentation would be just to hammer out and to communicate this things that are important to us when we manage your money, and as investors, what you should probably be aware of, and kind of get to know us about how uh, our process is and how we are thinking about managing money. So one thing is to the best thing for any relationship to have manage expectations, and the expectations should manage, right? I mean, it should match. So one thing is that I'll try to let you all know how we look at investments and what are the things that are important to us. After me, Rajiv will has a presentation. After his presentation, we'll get into the Q&As that have been sent so far. So the most important thing, and I've been saying it, and we've been saying it for a very long time, is the law of the farm. Uh, the core belief for us is the law of the farm. You cannot sow something today and reap the benefits tomorrow. Just like the seed has to go through various seasons, it needs nurturing, it needs sunlight, it needs your time to become a full-blown tree. So does the investments. I think the most important thing is that we need to give our investment time. From your point, give it time. From our point of view, we need to nurture the investments. We need to make sure that we are on top of all the investments we are making, and all we ask you is that give us enough time to perform, because nothing happens overnight, and even we've done there's been so much development in the world, but there's nothing as one seed cannot become a tree overnight. That has not yet come. So it has to go through the natural process. Same with investments, they have to go through the natural process. It takes time for the money to grow. uh, And then that leads us to power of compounding. Everyone talks about power of compounding, but power of compounding only works if you sorry, one second, just presentation please. Yeah. Power of compounding only works if we hold on for a very long time. In the initial years, you might not see the true potential of the power of compounding. Only after years have gone by is that your money starts really compounding, and that snowball effect really works. So, first of all, this is I've just estimated a growth rate of about 11%. And this is just for illustrative purposes. The chart, it's not like we have these returns or any of that. It's just for people to understand that if you see how power of compounding works, that the longer you let your money grow, the faster it compounds at the in the end of the period. In the first few years could be a bit frustrating, or you might not think your money has grown that much or that well or something like that. But I think if you hold it on for a longer time, I think you see the true benefits of compounding. So only if you hold your investments for a long time do you see such great returns, that compounding can get. One thing that we try to do and we are focused on is avoiding permanent loss of capital. Again, ups and downs of the markets are part and parcel, right? But I mean, we want to avoid the permanent losses, that if something goes down, then it has no chance of recover, or you can't even get your purchase price. One of the things people make a mistake, and something that we are focused is about not chasing a fancy. So when you chase a fancy, all you do is you pay a fancy price. The fancy ends, and you're left with a fancy loss. I mean, beyond that, nothing happens. If you've seen from the tulip mania in the 1600s to currently, if you see cryptos and all that, I mean, the same thing goes on. I mean, nothing different happens in the world. So one thing is that we are pretty. We don't like to chase whatever the new fads or the fancies of the market. What we try to focus is on management quality, the promoter quality. We want high quality promoters, managers. So maybe you won't see us investing in too many IPOs, and one of the reasons we don't invest in IPOs is that we want the managers or the promoters to at least have some track record before we invest with them. If it's a first time promoter or a manager, we would take our time to evaluate him, evaluate that person, and then only put our money if we are comfortable with him. Because in our experience, more often than not, if you partnered with good management, good promoters, good things happen, and it's vice versa. We've also had those experiences. So we are this is actually one of the key things, that the first thing that we have is the promoter quality. Secondly, we consider on business fundamentals than stock price movement, of stock performance. I mean, what we are trying to do is to analyze a business, okay, not a stock price, or if a stock will go up or down. I mean, we look at businesses because we like some characteristic. It has to have monopolistic characteristics, or less debt, more cash, high ROE kind of parameters, right? I mean, and it has to have a future. Again, if we think that the business characteristics are good for it to grow in the future, we'll invest in it, right? I mean, and there have been times where we've invested. I mean, that because we invested in something that the price has to go up or any of that, we are looking at businesses to grow, and stock prices don't sometimes move in tandem with business performance of a company. So yeah, so we are more we are more focused on the business characteristics. And lastly, we have to pay a reasonable price for it. How great a business, how good a management, but if it's not available at a reasonable valuation, then we will let it go. We will not invest in that company, and stay away from that, until we're comfortable with the price that to invest. Again, a lot of attention goes into return, and we all talk about returns. But I think more important, what we look at PPFAS is risk adjusted return, downside protection. I mean, I think if we could, I think we can protect the downside give a reasonable upside and try to do that consistently, I think we'll do. I think you all will do fairly well, going into the future. So just some parameters here. So again, this is a chart I've taken from Morningstar. The source is Morningstar here. What it says is, and this is our FlexiCap fund, the Parag Parikh FlexiCap fund. It's a 5-year return profile, a risk return profile. What it says that against the category that we are in is the FlexiCap category. The risk versus the category is low, and the return versus the category is high. And those are some of the parameters that they use. I won't take too much time on the parameters, but essentially it says that alpha, or the overperformance over the index, is over 5 years, we've given about 6% extra returns compared to the average category returns, which have been slightly negative. Beta, or the volatility, we are less volatile than the category or the index itself. And standard deviation, which is the measure of risk, we are much less than that too. Again, the interesting thing is, if you look down, the upside downside capture ratio, which is quite interesting. What it says that if the index for us is the NSE 500, if that goes up by 100, the category FlexiCap goes up by 92, whereas our fund will go up by 87. So we definitely are not performing better than the category or the index on the upper side if the markets go up by 100. But look at on the downside, right? I mean, if the index goes down by 100, the category goes down by 95, whereas we only go down by 56. So I think the downside protection is really a good parameter to judge a fund by, or something that we are more focused on is like protect your capital. Like I said, avoid permanent loss of capital. That's kind of what we want to do. And this is kind of what we want to do, is to optimize returns for the long term and not maximize returns for the short term. I mean, when you maximize return for the short term, then you will be chasing the fad and the fancies. You will be taking excessive risk in the short term. You will be chasing the herd, or what's coming, what is the most popular thing right now, to get that quick buck or the quick return. For us, we try to actually avoid that, try to avoid chasing the herd. So you would see at times when markets are very expensive or something, that we don't mind. And if you're not getting any good opportunities, we don't mind being in cash, and we've got cash positions. Or we don't mind investing in neglected sectors or stocks that people are not investing. So we are not trying to maximize return for the short term. So yeah, I mean, people keep telling us about 3 months, 6 months, 1 year performance. So we are more looking at it to optimize returns for the longer term than to maximize in the shorter term. Again, we all have heard about this saying by Mr. Warren Buffett, be fearful when others are greedy, and be greedy when others are fearful, right? I mean, it's easier said than done, right? When a fall comes or the markets are going up, it's very hard to do the opposite of what the market is telling you to do. But kudos to the fund management team. They've been practicing this, and the 3 recent examples are in 2007. This is way before we were a mutual fund. We were a PMS at that time. Again, that was the time of the financial crisis, right? And markets were on a tear, going up. The index was up by 50-60% in 1 year. And we were up by only 11% because we had around 30 or 40% cash in the position, right? Cash position in the portfolio. So we were massive underperformers in that year, in 2007. But 2008 came, and we more than made up for the underperformance of that year or 2 years, And again, we didn't see permanent loss of capital because we didn't invest in stocks which were the fancies at that time, like real estate, power, infrastructure stocks, So we stayed away from that, and which I think helps the unit holders or the investors over a longer term. You might think that period might be a little painful, when the underperformance is there. But that's what we're trying to do, is to not really concentrate on 3 or 6 months or 1 year kind of performance. But will these decisions help us and our investors over a longer term? And would they not lead to permanent loss of capital? And that's a question we asked. That was 2007. Recent example is 2017. In a mutual fund, we were a mutual fund by then. In our FlexiCap, in 2017, we were at the highest about 29 or 30% in cash, right? I mean, at that point, and that was a time when small caps and mid caps were just going up one way. Again, we underperformed that time also. Shorter term underperformance were there, but that cash really helped us later on. When markets actually fell and gave us opportunities, we could buy into companies with good valuation, and that continued all the way till 2020 when COVID hit. When COVID hit, everyone was fearful. Everyone thought the world's going to end, but at that point, we thought that, wow, I mean, we're getting some great companies at great valuations, and we have some cash position because we didn't invest in uh, things that were fancied at that point, and that really helped us out. So I think sometimes every few years we get opportunities, and again, if we can maximize those opportunities, it's great. It's not like every day the markets gives you opportunity. It's once in a while. So as long as we can do that, I think over the longer term we should be fine. Yeah, so I keep getting asked, and we keep getting asked, guys, what are you doing about the volatility? Market is very volatile. बहुत volatile है market. क्या कर रहे हो? What are y'all doing? How y'all handling the volatility? All these things. So, I mean, in the end, don't know how to answer it, but just tell those people that volatility is a feature, it's not a bug. It's supposed to be, markets are supposed to be volatile. There's nothing, uh, there's nothing else to it. Because it's and investors will have to go through these ups and downs, this kind of roller coaster ride. You have to go through some of the bad times to see the good times. You can't just have the good times all the time. So, and because of that, because the markets are volatile, you get lumpy returns. By lumpy returns is that there'll be periods of 2-3 years where you might not get any return, but the fourth year you will more than make up for all that returns. So when we say, when people say I've got, okay, 15% CAGR returns, it doesn't mean that every year you've got 15%. There could be years where you've got negative 20%. There'll be years you've got positive 30%. So that's why we say that if you have a long enough, when you have a long enough view about the markets, I think that evens out and you get a decent return. But in the shorter term, that looks pretty scary. Volatility is scary, but it is actually part and parcel of the markets. So there's nothing new to that, and which also will lead to short term underperformance. It's not like any fund house or any fund will keep probably outperforming the markets at any given periods or all given periods. But here, if we're looking at a longer term, we want to perform over a 5-year period or at the minimum, in equity. So this is kind of been the journey of the flexi cap fund over its lifetime. There have always been times of underperformance. I mean, you can see it's against the BSE 500 try and the flexi cap category. There's always been underperformance, and it's not new, and it's not never going to happen also in the future. It's always going to happen. It's always happened also. But I think if we take common sense steps about the portfolio, about investments, about not doing something crazy or following fads and fancies, and just stick to the basic principles of investing, I think we've seen over a longer term, I think the returns have been pretty satisfactory. Again, this is flexi cap. This is the tax saver. I mean, similar journey as such, in the sense that there have been periods of underperformance in the tax saver fund also. But over time, I think if we can manage over a 5-year period or whatever to give like above average returns, beating the benchmark and the category, I think that should be fine. So I don't think we need to stress too much about the shorter term. That's what my whole thing was. Again, investing is supposed to be boring. The day it becomes exciting, you are not investing. So if you want it to be exciting, then I can think of a few more ways other than the stock markets where things are more exciting. I mean, going to a casino or going to a horse races, they're probably more exciting than the markets, right? I mean, you at least have fun doing it. And so, uh, yeah, it's supposed to be boring. And the things that we take care of and what you all can, what investors should do is obviously follow a process or a plan. We have a investing process that we follow pretty stringently, and we don't deviate too much of that. We have our circle of competence in the sense that there may be thousands of stocks that are listed, but we track about 500 stocks in India and globally, and that's our circle of competence. That's what we think is that we are good at, and this is the thing that we know these companies pretty well. And if there are opportunities in this basket, we will take care of them. Beyond these 500, 600 stocks, if some stocks happens to do really well, then so be it. You can't get all the opportunities, or you cannot be trying to profit from every stock in the market, right? I mean, so have a circle of competence. Again, for investors, have a plan, have a financial plan, do a asset allocation, and stick to it. I mean, stick to that plan. That's your circle of competence, because again, there'll be NFOs launched every week. There'll be thematic funds and sectoral funds, and a lot of things that are in the fad and fancy that will be launched. I mean, I think it's okay to not get involved in all of them. Just stick to your plan. If it has like three mutual funds that you're supposed to invest in, then stick to your three mutual funds. You don't need to uh, get into everything. That's my point. And not having FOMO. I think a lot of FOMO has happened over the last 2 years in crypto, and a lot of people we meet, at least the last couple of years, when cryptos and all were rising. They've like just put all their money in crypto, sold off their mutual fund holdings or whatever, and gone there. And I'm not saying any asset class is good or bad. I mean, look, as long as you'll understand, if you understand the risk, you understand uh, the asset or the product, and then you invest in it, that's fine. Do that. That's okay. But doing it haphazardly, or just doing it because you have FOMO, or you think you're going to miss out, or you're greedy that, oh, this is going to give you that extra returns or something, don't do it in that way. So avoid the FOMO, stick to your plan, have a circle of competence. Inaction is sometimes the best action in the market. I mean, if you're confused, you don't know what to do, don't do anything at all. And by that, I'm not saying that just blindly invest and forget about it. No, every year or 6 months, review your portfolio, review what's going right, what's wrong, but do that once a year, twice a year. Don't do it on a weekly basis, don't do it on a daily basis, don't look at NAVs every day and see, oh, what has happened, because that those those things will make you make bad decisions. So sometimes just let it be. Just let it be. Concentrate on your what is important to you at that point. So your jobs or your business or any of that, and markets will continue. Don't worry about that. And again, people need to decide if they want short-term excitement versus long-term wealth creation. So, yeah, if short-term excitement is what you want, then yeah, surely, then do what you want. But long-term, if you want to create wealth the longer term, then it is, in the beginning, it is tough. You might not see that many. Like I said, the power of compounding only works over time when you hold it for a longer period. So have that discipline and stick to that discipline. Again, we have a fiduciary responsibility when we manage your money. Means fiduciary responsibility means that we do what's good for our investors. I mean, that's kind of what fiduciary responsibility means. And if you are in the financial space, then I think that is kind of paramount to us. If you're managing people's money, that we do what's in your best interest. So one is, we don't have no flavor of the month scheme. So we don't launch schemes very often. The only reason we launch scheme is, if you have one, is that if there's a real need in the market for the product, if we are excited to put our own money in the in the said scheme, and if we think there's a demand or a need from our unit holders, that, or we can create some differentiation in the category or do it in a better way, then surely we will launch a product in that way. But we are not going to launch products just to gather assets. We are an AMC. AMC stands for Asset Management Company, not Asset Marketing Company. We're an asset management company. So we'll stick to when we think a product needs to, when we are excited about product, we will probably launch it then. But we will not try to get into uh, every category if we think we cannot do justice to that category as such. So that's one thing. There won't be any flavor of the scheme, or not too many schemes from our side. uh Profession versus business. We are professional. We consider ourselves as professionals. Again, a professional is someone like a doctor, a lawyer, who's supposed to be doing good things for his patient. I mean, that's what a professional means. Like, okay, you go to a doctor, you want him to work for your best interest, right? I mean, you don't want to just be a tick mark for him or something like that, right? So again, what we try to do is, what's in the best interest of our clients, we do it. Business considerations are actually very secondary. I think if our investors, our partners have a good experience, if we can do good things for them, we can perform. I think, yeah, I think business will come, and that'll happen if we do good things. So that's one thing. We have skin in the game, in the sense that we have put our own money along with you all, and we put a substantial amount of our own wealth in the mutual fund. Obviously, right now, I mean, recently there have been circulars where it is mandatory to have skin in the game, and each mutual fund has to. But we've done this long before skin in the game circular have even come out. Uh, we don't do only the mandatory. We do way more than the mandatory that's required. But I think for us, like I said, it's for us. It's exciting to put our money. We like our fund because we can put our money in it, and it's something that's good for all of us. So if it's good for y'all, it's good for us. So we put our money there. Other things when we are doing professional versus businessmen is that we don't have any sales targets for any of our employees. I think if you have fiduciary responsibility, then sales targets don't go hand in hand. If I give sales targets, or if there are sales targets, then any like people will just sell anything to anyone. Here, there are no sales targets. I mean, we communicate about our funds, and if people think it's good, if it's good for them, and if it's going to help them, then they will invest. But there's no sales targets as such in the organization. Uh, yeah, so we don't have any cluttering of offerings, like I mentioned, and this brings me to survivorship bias. Survivorship bias is basically if you're running 30 schemes, and at any given moment, two schemes will be doing well. So you can always market those two schemes and say, "Oh wow, you've done a fantastic job." For us, for better or for worse, we have our few schemes. The flexi cap being the biggest, and for good, even if it's not performing, we cannot hide behind its performance and market other schemes or anything, and we won't have it any other way. I think we're confident in what we are doing in the selections we've made or the choices we've made, and we are happy to answer those questions, even if in times of outperformance, in times of underperformance, we don't have any survivorship bias. So that's what it is. And we have open channels of communication. This is being one of them, where it's an open forum, and we can all chat and have honest questions with each other, and y'all can ask us anything y'all want to ask us. We have 4 schemes. If anyone's not, it doesn't know, we have our flagship Parikh Flexi Cap Fund, which can invest in Indian stocks as well as foreign stocks. Up to 35% can be invested in foreign stocks. Rest is in Indian stocks. The concept here is like a Swiss Army knife. It's like one device with multi functionality, so we can take advantage of all opportunities that are there in the market in terms of arbitrage opportunities, special situations, what have you. We can be in cash if it can be your balance fund. If you don't see any great valuation, we can be in cash for that matter. Then we have the Parag Liquid Fund. It's for your short-term needs to do SIP, STP. If you all have the fact sheet, then Rajeev has written a note that if you have idle money lying in your savings account, this is a good time to put it in the liquid fund. The liquid fund is giving some going forward decent return compared to your savings or current account. So you all might want to think about that. If you have idle cash lying, put it in the liquid fund. Parag Tax Saver Fund is the basically you get the ATC benefits of 1,50,000 if you invest here, which are tax exempt. But a lot of people have been asking me, why don't you launch this scheme? Why don't you launch a all India focus scheme? And the likes, and we were just internally talking, and we all came to the same kind of conclusion that if you launch another focus scheme or an Indian scheme, it's going to look exactly like the tax saver fund. It's not going to look anything different than the tax saver fund. So if y'all want only Indian allocation, then the tax saver is a great option to invest in. The only thing is got a 3-year lock-in, but if we are saying equities for 5 years and longer, then a 3-year lock-in should really not matter. So that takes care of the only Indian portfolio. If you or only focused Indian portfolio, that's the tax saver for you. And the others, we have a Parag conservative hybrid fund. It's in the hybrid category, but we look at it, and we would want you to look at it as a debt fund from our fund house. Here a minimum 75% is we have to invest in debt securities. The remaining we can go up to 15% in equities and up to 10% in REITs or real estate investment trusts and InvITs. Here the concept is that the 75% that we are investing in debt we don't want to take any credit risk there, or we take very low credit risk there, and that's kind of be the safe portfolio, the safe part of the portfolio. And again, everything, even equities, though they are more risky, the what we are trying to do here is not get into, you want to get into equities which have good cash flow, good dividend yields. So very defensive kind of stocks where dividend yields are really good. So you can call it quasi debt only. And REITs also is you can call it kind of a quasi debt, in the sense that it gives you rental income and a chance of appreciation of the land price. So we ourselves are very excited about this product, the conservative hybrid fund. I think it's great for people with medium term to long term debt needs, and please consider that as your for your debt investments, the conservative hybrid fund. So yeah, just summarizing, who's suitable to invest in our equity scheme: people with who have a longer term horizon, who can wait for 5+ years at least for the investment. Again, they're not scared of volatility, or they don't check their the NAVs on a daily basis or something like that. You look at it from a longer term perspective. And again, a simple kind of product, in the sense that for us, when we were coming out of the flexi cap, it's like the thought process was that what would we like to invest in, what would be a investment vehicle for us to put in our own money. And we thought that there should be one fund with, we can do everything within that fund, instead of investing in 6 different schemes. If there's one fund to do that, it's a simple kind of a thing. There's less confusion amongst people about the scheme, and that's what we preferred, and that's what we are sticking to. So even the conservative hybrid, it's got 3 asset classes, but in effect, it's, yeah, what would you want your debt fund to look like? And this is the answer we came. The conservative hybrid is kind of what you'd want our debt fund to look like. Again, in the debt schemes, what are we trying to do? We're not trying to profit from every interest rate movement that is there. We are buy and hold pretty much. We are buy and hold. We're not timers of the market in the equity or the debt space. So we kind of usually will hold till maturity. So somebody who's trying to profit from every interest rate movement, then this is probably not for you. Again, debt funds are more liquid and tax efficient option compared to other debt securities, fixed income securities, and again, prefer relative safety of capital. I think one thing for us is that we don't believe in taking too much credit risk in the debt portfolio. That's why the conservative hybrid is great, in the sense that that's 75% to get good return. We don't need to get into credit risk kind of things, get into papers of less quality. Here we can get the 75% can be invested in the best quality papers, and still we can get a good decent return going forward by having some REITs and some equity which are cash flow bearing. And with this kind of a thing, I think we can get pretty good return. That's why we're excited about this. That because this debt product will not have too much credit risk in it, and yeah, it's, like I said, we're not very fond of taking credit risk, because credit risk leads to permanent loss of capital. That's the thing. And yeah, interest rate risk is sometimes ups and downs are fine, but if you get stuck in a credit event, then it's very hard for your money to come back. And like I had mentioned, that permanent loss of capital is something that we don't look at very. We don't like that. So plans ahead, surprise, no scheme launches are planned. Yeah, there's no clarity on opening up of the foreign investment or overseas investments limit. I think, yeah, it's been almost 6 months, but going ahead also, there's no clarity as such. We've not got any communication from SEBI, AMFI, or anyone. I think when macroeconomically, when things look better, I think we'll probably see the opening up of the limits. But as of right now, there's no clarity at all. Again, we continue to focus on what we are doing. I think these 4 funds have each has a need of its own. There's no overlap as such, and I think we'll continue to manage these 4 schemes for the coming years. Again, we think something exciting is there, then we would think about launching something where, like I said, if we can do something different in that category or in the scheme, and it's something that we are excited about, we'll launch a scheme. Again, what we've realized is that branch expansion or having feet on the street is quite important. Unlike what was said in COVID, that physical office will go away, everything will be online. I think it's contrary to that is that you need people on the street. You need people in different cities. And for us, I think having branches in some of the metros has really helped us in this in terms of getting closer to our unit holders, our clients, our distribution partners. Um, I think that builds trust over time. So I think we're not going to blitz and have like 30 branches next year or any of that. We'll go slow and steady, whichever cities are showing good growth over the last 3 years. We'll probably think about them and open branches and representative offices there. Yeah, again, one thing that we want to concentrate going forward is to enhance the digital initiatives. There have been things that I've told you all 2 years back, and those have kind of still not happened. And apologize for that. It's been a bit slow on our side. It's obviously also the way the market is for developers and stuff like that. That we hired some people and they left very fast, and then we couldn't get more people. And yeah, and people were asking for the moon in the last year or two in the IT space. So that didn't happen as at a pace that we would like, but we will hopefully ramp up now. That things are looking much normal now in the IT space. So hopefully some of the features which are long pending will be addressed sooner rather than later. So yeah, we've got present in the top metros. Mumbai, we've got two offices, one at Nariman Point, one at Andheri. We've got branch offices in Ahmedabad, Bangalore, Bengaluru, Chennai, Hyderabad, Kolkata, New Delhi, and Pune. And we've got our representatives in Nashik, Nagpur, Surat, Vadodara, Chandigarh. I think that's Kochi, Ernakulam, and Jaipur. And over time, we'll add to this list, right? I mean, we do want to get into other cities, other places where we are seeing good traction. So slowly and steadily, we will build up our network too. So yeah, this is the performance table. I think you'll have it in your fact sheet, and I guess Raji will speak more on that. Uh, yeah, just regulatory thing. So thank you from my side. I will invite Rajiv now to have to give his presentation. Thank you, everyone.
Good afternoon. Thank you for taking the time out and joining us in person for those who are here and online for those who are participating online. Could we get the presentation up on screen, please? While the presentation is coming up on screen, you would have got jute bags with you, right? Those are pretty good jute bags, so please avoid the temptation of throwing them on stage. You can use it, right? Throwing them on stage will not help you much. So, for those who are interested, you could look up the source of the meme as well. It's called the Ballets of Buster Scruggs. It's on Netflix. It's a quite a hilarious thing for those who are interested in those kind of parody westerns. Yeah, cutting to the chase. FlexiCap returns last 1 year minus 3.24%. Benchmark, which is Nifty 500 plus 3.52%. First time. So why are we using these memes and pictures? Because a picture is worth 1,000 words. It conveys a lot of things. So I could bore you with statistics and with what is called gyan, and it would put you off to sleep. But I'll try and explain things with anecdotes, with stories, analogies, so that things become more visual and interesting in the discussion. And it's not poking fun at anyone, but all the poking fun is for the investment team and not directed at anyone else. So please don't take offense, and I apologize in advance for any offense that I may cause. So what are the confessions I have to make? These confessions are known to people who have been around for a long time with us as investors. But people who have joined in the past 12 to 24 months would not be aware of these, and I'll convey them. So the first confession is that this is not the first time that I have underperformed, or the team has underperformed, or the fund house has underperformed uh, in the equity schemes. So this is a snapshot from 2017. Neil spoke about this briefly, where the scheme returns on a 1 year basis were roughly 29.5%, whereas the index was up 36%. So it's not the first time. That is the first confession to make. The second confession is that it is not the biggest magnitude. So currently it would be roughly 6-7%, whatever difference between benchmark and the scheme performance. 2007 there were riots in our office. So we were underperforming the benchmark by 30%. So all the people who would be in the client facing role would have a miserable life, and internally they had a revolt on thing. And I actually went to our founder Parag and said, see, this is, I'm doing what I'm doing. If you think this is not good, then you could get someone else to manage the money. And like, people would have been very happy if that were to happen, the client facing people in our own organization, because clients would say market is up some 65%. What is your portfolio doing? It's up just 30-35%, and so much cash is lying around, and biggest bull run we are seeing in the market, and you are doing nothing. So it is not the biggest magnitude. Trust me when I say that. 2017, some people actually called up again, called up Neil and said, remove this person. What is the kind of guy you have managing the schemes for PPFAS? You have so much potential. You have a good brand name. You have a mutual fund license and all that. What are you guys doing? People have been very kind to me, saying that recent underperformance is because we have grown very large, because the fund size has gone up to whatever 25-26,000 crores. But again, confession in true spirit of disclosure and honesty, 2007 we were 150 crores, a massive underperformance. 2017 we were less than 1,000 crores again. So I don't need large AUM to underperform. I can manage that at any AUM size. I can do that with or without foreign stocks. So right now there is limit on foreign stocks, foreign investing. 2007 there was no foreign stocks. 2017 there was foreign stocks available. Any limit you want to invest. So all sorts of combinations are there. Again, I don't know whether it's because of AUM, because of foreign stocks, not foreign stocks, but I can do it at any size, any AUM. And the last part is the scary part. Don't run away. So it's not the last time again that this has happened. This will happen in the future as well, guaranteed. Right? Why is that a guarantee? Because when you do things which are different from what the index does, then you will have a return which is different from what the index will give. Sometimes it will be better, sometimes it will be worse, but it will never be exactly what the index does. And when you are doing what is called active management, which is doing something different than from what the index is doing, you hope to do better than the index over a cycle, but not all the time. That is the nature of what we do. I realize that with the presentation, I am cutting into the Q&A time a bit, but I think this is important for a couple of reasons. So one is that it will convey what I have to convey in a more structured manner. And the second is, most of the questions are around this. So 3 groups of questions that I could ascertain from the form that we had put out, and people generously put their questions in. So one group of questions is around the fund performance. Why is it underperformed? What are we doing to correct the performance and all those things? The second group of questions has been around individual stocks, especially the foreign stock ownership that we have, the ownership in Meta, which is one of the favorite questions, Google or Alphabet, Microsoft, Amazon, why do we own them, or why did we not sell them, or uh, things around that, and what is happening with the foreign stock investment limit. If it does not open up, how does it affect us, and what is our thinking around that? So I'll take a bit extra time as compared to the usual pattern that we have each year, and dwell on this so that we can address most of those questions upfront. And then later on, we'll take curated questions from Neil Borate, who's kindly agreed to moderate the Q&A session for us. These are the questions which people have filled up on the online form. And once we are done with those, we'll take live audience questions, which will obviously not be curated. So there are mics up front. So once the moderated Q&A is over, you can come up and then ask your question. Yeah, so let's dive into this. And I can empathize with the questions that are there. So just before the formal part of the session, we were chatting informally, and one gentleman came up to me and said, "What's happening? It's been a year or more. I've put money in your scheme, and the thing doesn't seem to go up. Even if the NAV goes up somewhat, then it again comes back down. What's happening?" And I can empathize with that. So it's not just this gentleman. My wife and daughter are politely sitting in the first row and also wondering why they are not wealthier today as compared to 1 year back. So they also ask me the same questions. Luckily here, you get to do it only once a year. They ask me every day. So that's the downside. So, and I can empathize with this because after all, at least directionally, things should be going well for you, right? If you sign up for a weight loss diet, okay, sometimes the weight may be flat, sometimes weight may come down slowly, but you don't expect weight to increase on a weight loss diet, right? So here you have given money to us for it to grow over a period of time. You don't expect it to remain completely flat or marginally downward or whatever. What is happening? And these questions have been like a very loving and caring parent uh, questioning, scolding a child after a bad report card, right? Uh, your marks are not good. What are you doing about it? Why did this happen? Number one, that is the first question. Why did this happen? And second is, how will you ensure that this will not happen in the future, and how you will do better the next year? Okay, now this is obvious. So far, we are clear on this aspect. Three outcomes after this question happens. One is that the child behaves like a good child, as is to be expected. Okay, Papa, I will not watch Netflix so much next year. I will study more. I'll do all my homework assignments, and we will do better. I'll get better marks next year. So, equivalent here, we could be all four of us would go to Neil and stand up before the audience and say, next year we will not watch Netflix, we'll read more annual reports, we'll attend more conference calls, we will read more books, and we will try and do better. That could be one thing that we do next year. The other thing could be that Neil gets very angry and says, I should punish you, I should cut your pocket money, or you will get only one coffee in office, or we'll cut your salaries or something like that. That is the second part. Both don't sound very appealing to me. So what I'll try and do is I'll try and take the third approach. Firstly, I'll try and explain to people in this audience and Neil that performance actually is not bad, and performance actually is very, very good. That is first attempt that I'll make. And secondly, to whatever extent performance is bad, it is the teacher's fault, because all the questions were out of syllabus, and meaning no blame remains with the investment team. So let's get right into it. So the subjects of physics and chemistry are easy in life, right? So in chemistry, if you combine two atoms of hydrogen with one atom of oxygen, at the end of it, invariably you get water. It never happens that after you combine these two atoms, you get olive oil or you get castor oil, right? That never happens. In market, sometimes you get castor oil and it takes your digestive system for a toss. That's the issue with equity investing. Equity investing is more akin to this. And again, to explain to Neil, I have a very handy analogy. Neil has been each year for the last 9 years saying PPFAS believes in the law of the farm. So now I have a farm analogy to tell him how there is no fault that attributes to the investment team. So what does the farmer do? A farmer ensures that the soil quality is good, that plowing is done on time, that the seed quality is good, proper fertilizers are given, proper hydration is given, water is given on time, pesticides are put at the right time, all the weeds are taken away. That is what the farmer can do, right? But what if there's a flood one year? What if there's a drought the other year? What if there's a crop disease which suddenly breaks out in a region and which destroys all the crop? What can the farmer do? So, Neil, what can we do? Right? So, what are the good seeds, water, and fertilizer of investing? Neil touched upon this briefly in his talk. But firstly, we've been saying this for 9 years, not just today, that we try and seek out to invest with good quality promoters and managers. We try and invest in great businesses as defined by high returns on equity, where there's some competitive advantage, which are preferably asset light, where there's low leverage, and where there's attractive valuation. These are the good seed, water, and fertilizer of investing. So, those of you who have read this book, 7 Habits of Highly Effective People by Stephen Covey, know about these two circles. The bigger circle in life, not just relating to this subject of investing, but generally, the bigger circle is what is called the circle of concern. It could be various things that could affect you: the political system in the country, the infrastructure in the city, pandemics like COVID, and all sorts of things. Those are things which affect your day to day life and even longer term life prospects. But most of the things you can do nothing about. Within that larger circle of concern, there is a small circle wherein things are there which you can actually do something about. So, can we do anything about Russia Ukraine war, price of oil, interest rates, recession coming in US or no recession coming in US, uh, semiconductor shortages or semiconductor excesses, shortage of containers, glut of containers? Can we do anything about that? Answer is no. Can we do anything about the stock prices? Answer is no. What can we do something about? The same things which I spoke about in the earlier slide: promoter quality, business quality, valuation, and stuff like that. So, again, the reason, and again, I'll compare this journey with the weight loss program that I spoke about. If you sign up for a weight loss program, you don't expect your weight to increase. But when you are on a drive on roads like this in a hilly terrain, going from point A to point B, many a times your car will seem to be going in the reverse direction as compared to the destination that you see in front of you. Many a times, instead of the car going up, will be going down on a road, because that road goes round and round and round before it finally reaches the destination, which is very, very akin to equity investing journey. I'll give specific examples as we go along, but keep this in mind. This is the reason why we keep insisting on long term returns. People who have been invested with us for some time and have attended plenty of these meetings would know that we have never gloated on short term results or even on long term returns. We have never said, oh, look at last 6 months performance, look at last 1 year performance, how great it is. So when we were not ecstatic, when 12-month performance was very good, you should not be depressed when 12-month performance is not that great. Because it's the nature of the thing. It's nothing that is unique or which is happening for the first time. In WhatsApp forwards, most of us fantasize about these kind of things. What happened? What would have happened if I had bought Wipro 30 years back? What would have happened if I had bought Google when it listed? What would have happened if I had bought Bajaj Finance 15 years back? Meaning, I would be incredibly wealthy, right? So, we keep fantasizing about those things. And it seems like all you had to do was buy them and hold. Very simple, right? So, let's look at what those journeys actually look like when you go about doing those kind of investments. So, this is the journey of Alphabet and Google. Great return, right? And the biggest drop seems to be in recent times. If you look at the magnitude, the blue line went up significantly and came down significantly. However, that is not the biggest drop. At the bottom of the chart, the red lines that you see are what are called the drawdown charts, or the percentages drop from the previous highs that have been seen in the past. In 2009, there was something funny that people like Lehman Brothers, Bear Stearns, AIG, and all these guys did. And Google had its stock price fall some 80% or so. Right? Nothing that Google did or did not do in 2009. And these 20, 30, 40% drops have been very, very regular in these kind of companies. And some of you may be tempted to think that this phenomenon is only for foreign stocks or only for tech stocks. So let's leave Google aside for the time being. Let's go to an Indian company. An Indian company which has done very, very well for people who bought this company. And all these company names are for illustration purposes. I'm not recommending a buy, sell, or hold or any of these, just to illustrate the steep falls that can happen even in great quality companies when you are holding them. So, Bajaj Finance has had 90% kind of drops many a times. It has had, meaning 20%, 25% is very, very normal. 40%, 60% drops also happen quite regularly. So, these are just two examples that I've given, but you can plot stock price graphs of many of these companies, and the returns and the results will be very, very similar. A lot of people have asked, why did you not sell these stocks last year? If you have invested with us, expecting us to know what is the bottom price of any stock and what is the peak price of any stock, and to enter at the bottom and exit at the top, then I think there's a severe mismatch in the capabilities that we have and your expectations. And I don't mean to mock people here, but that is not something that I know how to do. What we try and do is, we try and identify good quality companies. We try and invest in them at reasonable valuation. So what is reasonable valuation? There can be questions and we can discuss that and we can talk about that. But talking about exiting at a high price or anticipating that the stock price will fall, many times the falls come out of nowhere. So someone working at Google or someone who was a technology analyst analyzing Google will not know that somewhere Lehman Brothers is doing something or Bear Stearns is doing something and everything is going to come crashing down. We don't know that some virus is spreading somewhere in the world and the entire world will go in the lockdown suddenly. All these kinds of things keep happening and one has to be prepared for those. Neil spoke about this, but I'll reiterate. This is not something that we have recently put up on the website because 1 year has been bad. This has been on the website since we launched the scheme in 2013. Who is this scheme for? Who is this scheme not for? If you have 5 years, please invest. If you don't have 5 years, please, we are not the right people to invest with because I don't know what the NAV will be 6 months from now, 1 year from now. Those are very, very random things that happen, and interest rates go up, come down, recessions come and go, and COVID lockdowns happen. Various kinds of things can happen. Yeah, same thing. There's a section on why you should not invest if some things are not meant. Our fact sheet has had this red marker. It's oval now. It used to be rectangle earlier, but essentially saying the same thing. It's suitable only if you have 5 years. How long is long term? Minimum of 5 years. Longer the better. Lot of you would have seen the web series Scam 92 on Sony Live. Right? That's not the interesting thing about the web series or the 1992 scam. The most important thing about the 1992 scam, to my mind, is that the high that BSE Sensex saw around that time, 11 years after that, we were in negative territory. So BSE Sensex was 4,200 in 92 or thereabouts, and it was 2,850 in 2003. After 11 years, you had negative returns from equity indices in India. US markets have seen similar trend, 10 years of zero return. So equity as an asset class is not a substitute for your bank FDs or for your liquid funds or short-term debt investments. It's meant for your longer term retirement goals, your home purchase loans, your home purchase goals, or for child's education and things like that. These are meant for only long term goals, not for short term needs. And let's put things in perspective. And this is the part where I argue that the results are not really that bad. If you look at it from the frame of 1 year, it's minus 3.5 versus plus 3.5. If you look at over 3 years and 5 years, returns are pretty decent on a relative basis and on an absolute basis. Nothing to see here if you just zoom out a bit. And the more important thing, again, coming back to this whole noise around Indian stocks versus US stocks, should you be, and very funnily, in the questions that we have received, roughly half the people are worried that our foreign limit is capped, that we are not able to invest more abroad. That is one set of unit holders. The other set of unit holders are worried that why do we have any investments abroad? US markets are falling. We should have sold everything and been in a 100% equity kind of scenario. And both are contradictory in terms, right? So look at 3-year returns for FlexiCap and we look at 3-year returns for TaxSaver. So 3-year returns for FlexiCap, 22.74 per annum, and 3-year for TaxSaver, 23.43. Not much of a difference, right? This is akin to rounding error. Both are roughly 23% on a 3-year basis. I'm not saying this relationship will exactly hold true in the future or anything like that. What I'm saying is stop worrying. Right? So for 10 years as a investment house, personally, I have been part of the team which had managed only Indian equities, 2003 to 2013. Last 3.5 years, we have been managing tax-saver fund without any foreign investments. We can manage investing that way as well. If foreign stocks are not allowed. If foreign stocks are allowed, that's a good thing. Not because it gives higher return, but because of another thing. It gives a bigger opportunity set and it potentially lowers the volatility. Yeah, this is the chart. Depending on the starting point and ending point, you can make the case in various forms. You can make the case for investing in India or investing US, but it converges most of the time. So some of the time you will feel that the orange line is doing well. Orange line is US S&P 500. Blue line is Indian equities. And before you point out the currency effects, both are in Indian rupee terms. So again, nothing to see there. No worry on the front of exchange rate differential and anything like that. Over a whatever, wherever this chart begins, somewhere in 92 or thereabouts, over long periods, it's intersected 1, 2, 3, 4, 5, 6 times. Both converge, again separate, converge, again separate. So it's not that necessarily if you choose one market over the other, you will get higher returns. It's not that. Since the launch of the scheme, we have been saying the reason to invest abroad is to get opportunities in companies that are otherwise not available in India. So you don't have equivalents of Google, Facebook, Microsoft, Amazon, these kind of companies in India. You don't have too many upstream energy companies in India. You don't have too many innovator pharma companies in India. So it gives you a larger opportunity set. That is one. Second is it protects you from country specific volatility. So a GST introduction, a demonetization, a border tension with China, these things affect Indian stocks but do not affect global stocks that much. That has been the reason to add foreign stocks, not necessarily to get higher returns, because returns can be achieved in any market, uh, and depending on the starting and ending point, that can seem like a good place to be in. Okay, so that completes the taking stock of the 1 year performance and putting it in perspective. Try and look at it over slightly longer term horizons. Things seem to be more or less okay. Now we'll come to stock specifics, because there have been a lot of questions around the foreign stocks that we own and what is happening in those companies. Three broad worries can be there. Three broad questions can be raised. Not every fall in a stock price is a chance to buy, because sometimes the stock price falls and remains down forever. Right? So the question is, are these stocks where the share prices have fallen, like Enron or like a Kingfisher Airlines? So Enron was a out and out fraud where the books were cooked and people went to jail for that. Has some sort of a fraud come out in Alphabet, in Microsoft, Amazon, or Facebook? Answer is no. There's no fraud. Kingfisher was a very, very leveraged company. They were not able to pay salaries on time. They were not able to pay interest on their bank loans on time. Are these four companies very, very leveraged companies or losing huge amount of money, not able to meet their cash flow requirements? Again, the answer is no. So let's put that aside and let's not worry about that. Even if a stock has fallen 20%, 30%, 40%, it doesn't mean that there is anything that is wrong at the very basic level with those companies. The other worry that people have is that some people have been around in the markets from late 90s onwards, and they have seen the earlier dot-com boom, where you had uh, all the what were called K10 stocks in India, and all the DSQ softwares and Silverline and Pentafor and all sorts of companies which were going at crazy valuations. And forget those companies, even companies like Infosys and Wipro were trading at very, very crazy multiples. So let's look at Infosys. This is a slide from Infosys. So the first red circle that is there, they had a profit after tax of 286 crores, right? And they had a market cap of close to 60,000 crores. This is late 90s. The price earning ratio was more than 200 times. This is Infosys in the year 2000, early 2000. March 31, 2000. Now look at what happened to the stock price. After peaking out in early 2000, the stock crashed and did not reach the earlier level for 6 years. So for 6 years, people were losing money on the stock. And mind you, there was nothing wrong with Infosys per se as a company. The company kept growing its sales and profits over the 6 year period. It is just that the starting valuation was so steep that people had a huge opportunity loss by holding on to Infosys, and they only broke even after 6 years. So, did we have that kind of a situation in the uh, Alphabet, Facebook, uh, Microsoft, and Amazon in the last few years? I would argue not. So, rather than just make a general statement, we will look at the individual finances of all these four companies, and we'll try and make sense of what the valuations were like, what the valuations are like now, and what prospects do we see for these companies going forward. So, we'll cover those individual companies separately, but the third broad question that comes to mind, and a lot of people worry about this, is that in the technology space, the pace of disruption is very, very fast. Something which is very strong or seems to be very strong today, a new competitor comes in and that company gets wiped out. So, Yahoo was a dominant internet company in the late 90s, and today hardly anyone has Yahoo as their home page. It is still existing today, but people typically would go to Google or go to Gmail or go to Instagram or Facebook, or Yahoo is not their first internet company that they think about. MySpace, of course, I don't think it is there anymore. I haven't even checked. So MySpace or Orkut or these things are not around anymore. So this is the other thing people worry about. Are the companies that we are owning shares in, are they getting disrupted? Again, I don't think the answer is yes. I think these are very, very strong companies, and we will discuss each of these companies separately. Before we start discussing each of these companies, I've just put on screen some of the broad trends that we are seeing in the world today. Most of the people in this room today would be subscribing to either Hotstar or Netflix or Z5 or Sony Live or something like that. And if not subscribing, then would have YouTubes on their phones or on their connected TVs at home. And if you get used to streaming content on demand, you are not going to go back to linear TV saying, I'll sit in front of the TV set, I'll press a button on the remote, and I'll watch whatever serial or movie that the channel is broadcasting at that point in time. There's no going back. Once you get used to streaming, you will continue operating in streaming. Same way, all of these trends, once you get used to buying grocery at the press of a button and things getting delivered to your home, then it feels cumbersome to go to the uh, big store and fill up your cart and stand in the line at the checkout counter. So e-commerce, streaming, AI, cloud computing. So all of these trends which are there are trends which have existed before COVID, got accelerated during COVID, are taking a breather now, but are trends which will continue in the coming decades as well. It's not that we are going back in time. And the companies that we own are very, very strong players in some of these areas, and they will be on the right side of the trends that are happening. So let's discuss the first company, Alphabet Inc. or Google if you prefer. I'm sure more than 60-70% of the people in this room have an Android phone in their pockets. That's what the statistics say. Uh, on those phones, there would be apps of Gmail, there would be apps of YouTube, there would be Google Maps. This company probably knows more about you than your sibling, your parents, your spouse, or children. They know where you have been to, they know all the emails that you have received, they know what stocks that you own, where do you bank, what searches do you make. So, in fact, if you have watched the movie Red Notice on Netflix, uh, the threat to one of the person was that don't come near me, otherwise I'll disclose your search history to everyone. Right? So Google has all your search history with it. So I don't think anyone can seriously argue that this company is going to be disrupted, or that this company is in a space where Orkut or MySpace were. I don't think there's any serious argument here. It's in fact getting stronger and stronger each day. So earlier, you may think that Google search has been existing forever. You may think that Google Maps has been existing forever. But under the hood, the changes that are happening, you tend to take for granted, but you don't realize the significance of that. So Google Maps was just a place, was just an application where you could see the maps. Then there was navigation, where you could use it to drive from one place to the other. Then that same navigation changed from driving a car to riding a bicycle to walking to taking public transit. And now that is a platform for advertising. It never was a platform for advertising, because now you can have location specific advertising, or you can have uh, it can operate as a toll gate, where every time you take a ride on a Uber or a Ola, if that company is tied up with Google Maps at the back end, they get a small cut because their maps are being used for that. And down the road, those same maps are useful to some extent in their autonomous vehicle thing. So search has gone through various iterations. So with each passing month, with each passing year, actually their competitive advantages and moats are becoming stronger rather than getting weaker. So the question of, were we owning bubbly stocks, were we owning very overvalued stocks? I don't think so. So people ask us, why did you not sell it in 2021? It was at 28 times earnings for a company which is monopolistic. Now, a lot of Indian companies I have great respect for and are great companies. Take any of the good companies in India, let's say Nestle, Asian Paints, HDFC Bank, one of the companies that we own. All of these are great companies. But if you were to actually ask me which company has a bigger moat or a competitive advantage, I would think Google has a bigger moat because it's a monopoly. The other good companies are maybe dominant companies in their space, but they are still in a competitive market. So a 28 times earning kind of valuation in 2021, when these companies technically peaked out in this cycle, it was not really expensive at that point in time. So it was not like owning Infosys in late 90s or early 2000. Microsoft, same thing. So they are the dominant desktop operating system. They have a subscription based office productivity suite now with uh, all the Excel and Word and PowerPoint being software as a service offerings in many cases. Uh, they are the number two cloud service provider, and they have a advantage in the corporate sector as compared to Amazon because of their corporate linkages. Amazon has advantages in the tech space. So they are a very, very dominant company and growing quite well. Again, was it a bubble kind of company 12 months back? I don't think so. So there is a lot of times people ask, what did you learn from your mistakes last year, or would you have done something differently? Uh, if there was a learning to be had, I would have seriously tried to learn it. But here, I think it's just a random outcome where uh, the macro environment became tough and the stocks got sold off. Something like in 2009 or something thereabouts. Like people are worrying about corporate advertising spending or corporate tech spending and valuations, and some people were leveraged maybe, and there was a sell off in the stock prices. I don't think there's any significant learning from the investment process per se, because these were not overvalued companies. And if we were to go back in time, and if I had the same information in front of me, probably the outcome would be the same. Amazon, with each passing month, year, their delivery times improve, the price competitiveness improves. Uh, Big players in their cloud computing piece, they each item of their P&L account where they have an expense, they try and convert that to a profit center. So logistics used to be a big cost for them. Now they are running most of the logistics in house, and now they are trying to do it for other people. So uh, it's a very dominating company, and uh, if you are just going by price earning ratios, this may seem like a bubble like company last year and now, but we will talk about it. Uh, why, at least in our opinion, we don't think it's a bubble like company, why we think it's an attractive company to invest in. So broadly, these are the business segments that it operates in. The company currently has a market valuation close to $1 trillion. In the coming 12 months, there is a chance that they may do 100 billion revenue in cloud computing itself, and maybe earn 25-30 billion dollars from that. And it's a fast growing business. So arguably, the entire company's valuation can be justified on AWS alone, right? So some people may value it at, let's say, 700 billion, someone else may have a 850 billion valuation, but it's a very significant part of the company's profits and prospects. A lot of other things come to you which are not fully monetized or where they are not currently making profits. We can go on talking about this company probably for next 2-3 hours, 4 hours. So I'll be moving on, but people are familiar with this company. I don't need to talk too much about it. So we'll straight away move to valuations. I have not deliberately put the net income and EPS and P numbers here because some of their businesses make losses, but even a loss making company does not have zero valuation, right? So their retailing business currently makes losses, but they will have around $500 billion turnover from that retailing piece. The 1 trillion market cap that is there for Amazon can be justified probably only on AWS. So again, I don't think we were in a situation like Infosys where we bought and continued to hold in a bubble kind of scenario. Which comes to our most popular company of this year. So if there was a award to be given, that will go to this company, Meta Platforms Inc. Yeah, it is the ITC of 2022. uh, how many people in this room do not have WhatsApp installed on their phone? Raise of hands. Not a single person. Come on, there has to be someone, right, who does not have WhatsApp on the phone. Okay, so at various points in time, people have called the death of Meta Inc., saying now they have changed the privacy policy. They will, my data is no longer secret. They will use it for advertising. Uninstall WhatsApp and install Signal. None of you did it. So every now and then people say, oh, now TikTok has come. That is the death of Instagram. No one goes to Instagram anymore. No one, Facebook is for old people. No one goes on Facebook anymore. Right? So the trouble is that whenever quarterly numbers come out of Meta, you don't see that in the thing that they put out, either in terms of their revenue or the daily active users, monthly active users. Even Americans who till now were getting by on their iMessage on their iPhones have not now started coming to WhatsApp, right? So the products are well known. I don't need to explain Instagram, Reels, Facebook, WhatsApp, Messenger, Oculus, and all these. Oculus, maybe we'll talk about Oculus when we discuss Metaverse. Oculus and Metaverse we'll discuss. But Microsoft's, Meta's prospects are well known when you see the quarterly numbers. If you go by the mainstream media saying uninstall Facebook, uninstall WhatsApp, uninstall Instagram, the narrative is very strong, and Mark Zuckerberg is a favorite person for people to call and bash up. So he will be called to Senate and he'll look awkward in those hearings, and all sorts of things will keep happening. But let's look at the numbers. 2013, the company had a revenue of less than $8 billion. 2021, $257 billion. How is the company earning advertising revenue when no one is on Facebook or Meta products? This company was valued at 23 times earnings last year in 2021. Right now it's valued at 9 times earnings. Did we buy into a bubble and are we continue to hold on in the bubble? I don't think answer is yes. Is this company like Kingfisher Airlines, where they have borrowed a lot of money, they will go bankrupt? Answer is no. Is this company like Orkut or MySpace? Answer is no. Facebook, despite all the narrative, has all-time high number of users currently. WhatsApp is now growing even in North America, which was traditionally not adopting WhatsApp. Instagram is growing well. TikTok has taken some market share in terms of time spent on it, has taken some share of the ad revenue as well. They are somewhere around $10-15 billion, Ronak? Any ballpark? 10 billion, right? $10 billion in revenue, annual revenue. 10 billion versus 282 billion revenue. So TikTok is there, but doesn't mean that Meta has died. So what is the worst thing that has happened to Meta right now? That 39 billion profit has fallen to 29 billion profit in last 1 year. That is the worst thing that has happened. And that's why this huge stock price crash and all this gloom and doom kind of narrative around Meta. Why has that profit fallen? Of course, one part truth, part narrative is iOS changed its privacy settings and their ads are not as effective as pointing out correlation between the ad and a purchase decision and stuff like that. That has had some impact. The other is 10 to 12 billion dollars. They are either investing in metaverse or they are burning up in metaverse, depending on your point of view. But largely they are spending a lot of money roughly, I would say, a quarter of their profits, let's say, hypothetically. If they had $40 billion profit and 10 billion they are blowing up in metaverse, then a quarter of the profit they are flushing down the toilet, let's say. Worst case. Because of that, the company has been bombed out. So, what is our stance on it? And why are we continuing to own it? Firstly, who's the biggest loser when these share prices fall? The three founders are still significant shareholders in the three companies. Larry and Sergey in Alphabet, Mark Zuckerberg in Meta, Jeff Bezos in Amazon. Microsoft now is a diversely held company. I don't think one can still call it a company with Bill Gates as a founder or something like that. So, in the first three companies, the founders lose a lot of their wealth if the stock price comes down. Much more than what you and I are agonizing about for the past 45 minutes. They are the biggest losers. The employees, a lot of them who get paid in ESOPs and paid in their company stock, they lose a lot of money. So, it's not that they are enjoying the stock price coming down. Let's rewind and look at what happened in the last 2 years or 3 years. When COVID struck, physical stores were shut completely, not just in India, almost the world over. The entire physical demand moved to the online demand, e-commerce demand. Massive shift towards streaming, massive shift towards digital advertising. A lot of these companies were not prepared for a huge amount of growth. Amazon had to expand its physical network 100%, meaning doubling of their capacity in 2.5 years. Just think about it. Doubling the number of trucks, number of employees, warehouse capacity, everything in 2.5 years. In the middle of pandemic, when it's difficult to hire people, difficult to get people out of the home in such an environment. So in such an environment, there was a big shift towards these digital companies. They benefited a lot. We as shareholders benefited a lot in 21. These companies are giving back a part of those gains in 22. That is one big change that happened in the past 2.5 years. It's not that there's anything fundamentally wrong with this group of companies. More or less, they are doing fine. So let's come to metaverse, the most hated thing about Meta Platforms Inc. I would argue that you need not have an opinion on metaverse to invest in this company. Whether metaverse succeeds or fails is largely immaterial at this point in time when you are either owning the stock or buying the stock. I'll tell you why. Firstly, these side bets are nothing new. This has been happening for ages. Earlier, it was just Facebook. They acquired Instagram, which was a side bet at that point in time. They acquired WhatsApp, which was a side bet at that point in time. They were trying to do something like a stable coin in crypto, in case people have forgotten. They tried to launch a stable coin called Libra, later on called DM. And the project didn't work. They had to scrap it. So be it. So, this kind of creating side bets has been in the culture of all these four companies. Google had acquired Nest, those connected thermostat companies, for $3 billion. What happened to that? I would term it as a failure. I don't think that significantly contributed anything to Google, but such things happen. They acquired YouTube at one point in time, which was a side project. They acquired Maps at some point in time, which was a side project. So some side projects succeed, some don't, and it is the nature of things. So inherently nothing wrong with their trying their hand at metaverse. If it succeeds, we'll benefit from it. If it does not succeed, they are blowing up roughly a quarter of their profit on that. Remaining 3/4 of profits are there for us as shareholders. Is that too much? Are they spending too much money on it? I think the answer is yes. Probably they got a bit arrogant in the growth in 2021 and thereabouts, and they overestimated their profitability, which they have admitted. So they are cutting costs. All four companies are cutting costs, are trying to right size given the new economic environment. But this kind of side project is nothing new. That's what I wanted to convey. And again, if you are a shareholder for 3 years or 5 years or 7 years, metaverse won't even matter in your holding period, because the success or failure will probably be known after that. Some small impacts will start to be seen immediately, because something like Oculus, which is their headset and which is an alternative to buying something like a Xbox or something where you can play games on the headset in a virtual reality or a augmented reality world. So those kind of things will start coming immediately, but largely we'll know after many years. And I'll give an example of that. Look at the year. This is 2009. This is when Google's self-driving car project was started. 2009. This is now called Waymo. 2020, which is after 11 years, they actually launched the driverless ride-hailing service in Phoenix, Arizona. It took 11 years. So many of these projects are long drawn. So the metaverse investments today, we will not probably know for next 5 years, 10 years whether they were useful, not useful. I may think they are useless. Mark Zuckerberg thinks they are wonderful. Doesn't matter. We can have difference of opinion. But what is a fact is that the company is still throwing out a lot of cash. And it's very cheap. It's not obsolete. And we can continue to own it. For those who are interested, this is a wonderful book on the journey that Google did in the self-driving car thing. And just think about it while we are on it. When we are buying Alphabet today, and when I showed you those numbers, 30 times earnings or 20 times earnings, we are not paying anything whatsoever for these side projects. Just think about it if this becomes successful, where they become a global Uber company without the driver, where they buy the cars in bulk so that they get the cost advantages. They get to buy the fuel in bulk, maybe initially petrol or diesel and later on electricity. Insurance, they can self-insure or buy insurance in bulk and have a cost-effective alternative to the human-driven cars. I don't know whether they'll succeed or not. They are already operating in 3 cities. But the important part is that we as public shareholders are getting all these side projects for free. We are not paying anything for these. And those are like free lottery tickets. A lot of the times they have paid off. So, for example, YouTube paid off big way for us, or cloud computing paid off in big way for Amazon. And failure is part of the story. So, a lot of you may not even remember this, but there was this Fire phone that Amazon had launched, a spectacular failure. So, some projects will win, some projects will fail. We are not paying any valuation for those side projects. We are buying them only on the cash profits and the things that we can evaluate. Did these companies become too arrogant? I think the answer is yes. Do they need to do some spring cleaning? I think the answer is yes. It's easy for us to say spring cleaning. A lot of people are losing jobs, which is kind of sad, but they are responsive to what is happening in the environment. If the revenues are not growing, they will not let the costs grow. So don't worry about the environment. There are responsible people heading these organizations, and they will do what is required. Overseas investment limits, Neil mentioned. Right now, there's no update to give. We cannot buy more shares by remitting money outside. We are buying more shares from the dividends that we get abroad. But the interesting part is all four companies that we own, or we own five companies, Suzuki is the fifth one, but all these four US companies are buying back their stock. So even though we can't buy them, they are doing share buybacks on our behalf. So don't worry, we are able to benefit from the low prices that are there currently in those markets. And whether overseas limits are there or not, we will, given the environment that we are given, we will keep attempting to find good investment ideas and invest in those. So uh, I'll be completing 20 years as uh, a professional investment manager early next year. In 20 years, it's only for a short period of time that I had the opportunity of investing abroad. Rest of the time, we have been investing in India. So it's not that we are new to investing in India. Tax saver fund is doing just fine investing only in India. If we if the limits are increased, that will be a great thing. That will give us more flexibility. If that doesn't happen for some time, that is also okay. I'm sure as and when the macro environment permits, the limits will be enhanced. Thank you for a patient listening, and we'll dive into questions. Thanks.
Hi everyone. So I'll first quickly introduce myself. My name is Neil Borate. I am the personal finance editor at Mint. Some of you know our newspaper through our website livemint.com. Um, so so my job is, and my team's job is, to report on mutual funds, pensions, insurance, the entire spectrum of personal finance in India. Um, there are a lot of questions. So if you do have anything interesting to add, you can tweet me. My Twitter handle is @ActorsDaily, or yeah, that's probably the best way of doing it. But there is a limitation of time, so I'll do my best, but I can't promise anything. Um, it is a huge privilege to be here, and I'm very grateful to Neil and the team for inviting me. This is, somebody on Twitter said that this is India's Omaha, and in a sense, it is that. It is every year you get more and more of that feel, where just like Berkshire Hathaway, they take questions on the stocks in the fund and they answer stock by stock. You don't see that anywhere else in the industry. This kind of direct unit holder connect. Incidentally, I'm also a unit holder. So whatever pain you guys are going through, I'm also going through it. And I'm very close to the table, so if I throw something, then within arm's length. Um, so I won't repeat. A lot of questions have come on the US stocks, overseas limits, etc. And Rajeev has already addressed them in this presentation. So I don't want to repeat those questions. Let me begin instead with an international stock question, but a slightly different one, which is, Rajeev, have you considered other international markets like Europe or Asian markets? China, we've seen a massive correction, wiping out, I think, 20 years of returns or something. So any views on that?
We most definitely have. In fact, a lot of people think that the benchmark for PPFAS mutual fund or the FlexiCap fund should be uh, Nifty 500 plus plus Nasdaq or something like that. But in our investment journey, if you go year by year in the fact sheets that we have had, we have been investors in companies like Anheuser-Busch, which is a European uh, alcoholic beverages company. We have had investments in Nestle, the Swiss company, which is a global FMCG company. We have had investments in Standard Chartered Bank. Uh, we currently own Suzuki Motor Corp, which is the auto company and parent company of Maruti. We have owned 3M, which is in the US, but which has global operations. So we have been investing in European companies, and we have been investing in Japanese companies and stuff like that. On China, uh, we have been asked since pretty early days that since you are investing in companies like Google and Microsoft and stuff, why don't you look at companies like Alibaba, Baidu, and Tencent? And the nudges became even more enhanced when Daily Journal Corporation and Charlie Munger invested in Alibaba, and it came out that Li Lu is investing in uh, China and in Alibaba. So we did a deep dive. For those who are interested, there's a 1 hour talk on this subject on our YouTube channel. It's titled "Love China or Hate China." You cannot ignore China, and we discussed the various aspects about China. But for various reasons, we were not comfortable investing in China. One is the political situation over there and the environment, which is not really a capitalistic kind of environment. Second thing is that the most attractive space in China, which is the tech space, is legally prohibited for foreign investments. So all the investments which are supposedly being made in Chinese tech space are actually investments in ADRs, which are ADRs of a Cayman Island probably, or a British Virgin Island company, which has some obscure subsidiary on mainland China, which has some side arrangement with the operating company. It's not really an investment in Alibaba, Baidu, or Tencent. So we were not comfortable with such an environment, and thankfully so. So we have been saved from uh, investing in that. So after doing a deep dive, we came to a conclusion: this is not for us.
Let me now sort of take one step back and ask a more process related question, which is how do you decide the weights to companies in the portfolio? Do you have a preset notion that you want to allocate this much percentage? And in that context, I mean, one thing to note is that the international allocation has fallen from about 30% in February to 15% now, latest fact sheet. So has that led to a kind of missed opportunity where you just can't add more?
So the weight depends on various things. One is uh, the longer we have been invested in a company and the more uh, conviction we have in our ability to track a company, the easier it becomes to have a slightly bigger weight. That is one. Second, many a times the weight increases come on account of the stock price performance. So if a stock that we have bought for a 4% weight and the stock price immediately doubles and becomes a 8% weight in the portfolio. So many a times the weightage comes on account of the increase in the price of a stock. Sometimes we view a group of companies as a representative basket for a particular sector, which is the case with our pharma holdings, where we typically have, let's say, a 1% kind of weightage in 5 companies, and that's a 5% pharma sector allocation, because individual company risks can be very, very high. So, weightage decisions can come out on account of various factors. Coming to the specific on foreign stocks, let me give a very rough number. This is not very, very arithmetically precise, but uh, it's better to be approximately right than precisely wrong. So, uh, let us say the foreign stock weightage was 24%, and the foreign stock prices fell by one third. That 24% would come down to 16, which is what it is today. If stock prices went up, that would go back to 24. So Indian market has been more or less flat, or we are close to all-time highs in India. Not very far from the high level that Nifty has seen. Foreign stocks have had a big dip. That is a large reason for the fall in stock prices. If the stock prices recover, the weightage will also recover to a large extent. Some of these fall in weightage is because of additional inflows over the last 4-5 months since the limit has been stopped. But that's not the biggest factor. Biggest factor has been the drop in stock prices. We would have loved to buy more, but since we can't buy, as I mentioned, the buybacks are going on reasonably aggressively at the 4 companies. So we are becoming bigger shareholders in those companies in percentage terms. We are reinvesting the dividends that we get to whatever small extent. And we'll wait for the limit enhancement to happen as and when it comes about.
So I'll just finish off this point on weights from a question that we've received. And it goes as follows. There continue to be multiple stocks in the portfolio with below 1% allocation since several years, like ICRA, OFSS, etc. What is the rationale behind holding these stocks?
Yeah. So each stock will have its own story. It's not rationale which will go across various companies. So ICRA has been a holding for a very, very long time. We used to own before it was a Moody's subsidiary. And at that time, it used to be, if I'm not mistaken, something like 6-7% of the portfolio. And then the stock price went up 5-6x in a very short span of time after Moody's acquired announced its open offer and became a majority shareholder. So at the higher prices, we were sellers of the stock, whether on account of our selling or whatever. Our selling would not have mattered so much, but we kept selling in small pieces over a period of time, and then the stock price corrected. So when the stock price fell very significantly, then we did not feel like selling it at valuations which were then not very expensive. So we exited bulk of our position. This was the residual position. And even though the portfolio weight is not very large, as a percentage of the holding in the company, it's not insignificant. So sometimes in the smaller companies, it may so seem that the weightage in our portfolio is small, but as a percentage of the company, we may be owning a reasonable amount of the company.
Now, in the tax saver fund, you've actually done quite well. In the last year, I think it's a 10% return. Why this massive differential with FlexiCap? What did you do differently in the tax saver fund?
Nothing much. So as I said, the foreign stocks have fallen whatever 25-30% or thereabouts, and which if a 30% weight falls by 1/3, then that's minus 10% right there.
So now let me go to some sector-specific questions. So the first question is pharma. This is for Ronak. Healthcare is a diverse sector with many sub-industries like APIs, formulations, diagnostics, etc. However, when you look at our portfolio, there are 4 to 5 names: Cipla, Sun Pharma, Dr. Reddy's, Ipca Labs, Zydus. Most of these companies derive their revenues from the US generic market, which now seems to be a broken business due to loss in pricing power. What is our approach to stock selection in this industry, and why do we seem to be more bullish on the US generic market over other subsectors? So that's one sub-question. The second one is, what are your views on the long-term growth potential of some of the subsectors mentioned?
So pharma as a sector, when we started investing in that space, the biggest challenge facing the companies at that time were the FDA warnings, and plants were banned from exporting to the developed markets. So it seemed like a very interesting buying opportunity, because in the past, whenever there have been warnings or alerts or export bans, the companies would have resolved these issues over the next coming years, and then the plants were allowed to resell or resume selling to the markets from where they were banned. And the same thing has happened in many of the pharma companies. That was one of the entry points where we decided to enter. But when we saw many of the companies, the some broad characteristics which were similar to them. One was most of these companies had a reasonably strong balance sheet. They had a global presence in terms of marketing presence and selling to different countries, not just the US or North America, but even in developed Asia, even in Europe, even in domestic market, they were pretty strong. So these companies had a diversified sales presence. Number three, they had diversified product presence also. They were not deriving huge amounts of profits from, say, a handful of products. They had a different vertical, what they say, basically about ophthalmo projects or gastric drugs or heart drugs or central nervous system or clinical drugs for that point of view. These different portfolios also were there. So you had a variety of products, good balance sheet, management's ability to sell different places, and the price point was so attractive because of the FDA issues. That's when some of the positions entered into the portfolio. Another interesting thing about these companies, so one aspect is the US piece, where these companies derive a disproportionate revenue and profit from the US market. Most people think it is dying, but in fact, many of the products that are there, which are coming off the patent cycle, are actually uh, companies products which these companies have already done R&D on, and whenever the generic product will be launched, some of these products will be marketed in that market as well. Whether it is broken or not, and whether pricing power is gone, which is again a cyclical aspect of all these products. As more and more companies start getting a generic capability of making the old products, the product's price keeps falling in the market. This is the trend in the generics market. Whether generics drugs will be required or not, I think is not debatable, because most countries who are buying drugs, most people who are buying drugs, the price of drugs wanting to be cheaper and cheaper, that trend is going to continue. And wherever we have manufacturing presence at scale and they can profitably make these products, people will find some cyclical problems in at some points in time. But I think pharma as a basket should do okay. Now, whether in this basket these are the best companies to own or some other companies could have been, so we keep evaluating that. And in the past, most investors would have noticed that we have sold Lupin and we bought Cipla, that kind of change, and we keep on continuously adding to existing positions. But essentially, we want to hold it as a basket rather than buying one company where we may not know whether that one company's fortunes will do well or not compared to the rest of the basket.
Let me now come to PSUs. So historically, I think PPFAS hasn't had a lot of PSUs, but they've been added. So the question is, PSUs in the long term have generally been wealth destroyers, and yet we continue to invest in some PSUs. Can you please elaborate your rationale for investing in Power Grid, Coal India, IRFC, Petronet? Also, are the dividends received from these companies taxable?
So I have not been a fan of PSU investing for a long time. Uh, in fact, on the YouTube channel, there's a talk on the book The Descent of Air India, which to my mind was symptomatic of what was ailing the public sector companies in India in general. And it's true that a lot of companies have been massive wealth destroyers over a decade or more in the space. So we have had uh, some PSU investments in the past. The last one being, or the last few ones being the gas companies. Indraprastha Gas was there. We used to own Gujarat Gas at some point in time and stuff like that. Currently, we own Coal India, we own Power Grid Corporation, and we own NMDC. Something which has changed and which has been forcing me to change my opinion a bit on this space. And it's not been just one event or just one day I woke up and felt that, okay, now we should be buying PSU. It has been something which uh, has been a developing story as more and more data points have been coming. Uh, there has been a change in the outlook. So let me take you through some of the data points that came about. So this was a weird press conference that the finance ministry had, and this was in the peak of pandemic, in the COVID crisis. So where everyone was worried about when will lockdowns end, what will happen to interest rates, will there be bailouts of some sectors or not. The finance ministry came out and said, now we have this Atmanirbhar Bharat kind of approach, and this is our approach to PSUs, and we will be in only these strategic sectors, and we will exit other companies, and we will merge companies and all. It was almost like a Margaret Thatcher kind of announcement, but it was at such a time where no one wanted to actually listen, including me, meaning our attention was in various different areas. And then they said we will privatize Air India, and the general feeling in the public was, oh, where have we heard that before? And uh, government after government keeps talking about that, and nothing will happen and stuff like that. And then they said we want to consolidate uh, PSU banks in India, and they actually went out and merged quite a few public sector banks. And now they are saying we will privatize IDBI Bank, for example. So it's been various announcements, and it's been actual implementation of some of those announcements. So that has been the one part where the governance, they want to improve, they want to leave business to businessmen and focus more on the social sector, on national security policy, health and education and things like that, the national priorities. That has been one part. The second part has been in terms of the valuation. Because these have been wealth destroyers, and because these are so unpopular, then the moment you mention PSU, people just switch off. No one even wants to look at these companies anymore. And because of that, the dividend yields on many of these have become very, very high. Price earning ratios, in many cases, mid single digits. So something like a Coal India, meaning at some point in time, 5 times earnings and 10, 11 times dividend yield and stuff like that. So things became very, very attractive. At the same time, I understand there are risks. So periodically they come and give us a scare. They scare the living daylights out of us. So IRCTC shareholders, for example, got a scare that, oh, 50% of the revenue now Ministry of Railways will take away. Or suddenly one fine day, there were rumors that Power Grid will be forced to acquire REC. But luckily, in all of those cases, they walked back. They saw the market reaction and they said, okay, minority shareholders don't want this and we'll not do that. So that has been the good part. Yeah, but it's been a gradual shift over the last 1 to 1.5 years. Yeah, dividends are not taxable for us. So whatever dividends we receive are tax free. Dividends that we get on foreign companies are taxable in US. So we pay 25% tax in the US. But most of the companies that we own are not dividend paying, or at least 3 of the companies we own are not dividend paying. 2 are. On those 2 companies, we pay 25% tax in the US.
So as you said in your presentation, Rajeev, you often receive the same question and then the opposite of it. So the next question is, our current portfolio clearly suggests that we are not averse to investing in PSUs. Why then did we choose not to invest in PSUs or oil companies in 2021? So there was a big rally. Did we not do it in enough quantity, with enough aggression, and catch that rally?
I haven't tracked that period, and so, but that's the nature of things. So when we are buying 25, 30 companies, by definition, we are not buying whatever 3,000, 4,000 companies that are out there, and some company somewhere will be running away, and we will not be participating in that. So as long as our portfolio is more or less doing okay, we are fine with that. Yeah, and many a times we wait for evidence to be there rather than just go before the evidence is there, or based on anticipation that something will happen or not. So as I spoke about PSUs, it's not just the announcements that we are confident of. So it's not that immediately after some announcement we went out and bought PSU stocks. We've been doing it gradually. We have been watching government action, not just words and company actions. And yeah, we own some of them.
Okay, so let me now turn to BFSI. Among the larger banks, it seems that the entire investment community is bullish on ICICI Bank, SBI, and Axis. However, we seem to be more bullish on HDFC. Could you explain the rationale for the same? The answer becomes interesting in light of what happened just a couple of days ago. So there's a follow-up question on HDFC and HDFC Bank. So perhaps if you could answer this first, and I'll give you the follow-up.
So we like all of the names that you mentioned, and some which, or Kotak you did not mention. Even that's a good bank. So it's not that we have anything against any of these banks. ICICI is a good bank. Axis is a good bank. HDFC is a good bank. We own all three of them. Weightages depend on our view at that particular point in time. So HDFC has had a longer history of uninterrupted, good quality governance and good credit processes. ICICI and Axis have done much better in recent years, but their thing has been more or less cyclical. So in a bad cycle, they have ended up being on the wrong end of the loss cycle. And the valuations of HDFC Bank have been lower as compared to their past averages. People have been a bit circumspect about the proposed merger, and a lot of people actually sold off anticipating that one of the two will be taken off the indices or something like that, and purely on a technical nature, saying if they are removed from the index, there'll be a selling, and I'll sell before that and I'll buy it back after they are removed from the index and stuff like that. We didn't want to do any of that. Said we like the company, we'll buy it and hold it till the merger is complete.
So the follow-up question is, what are your expectations from the merged entity of HDFC Limited and HDFC Bank?
So firstly, it frees up some capital. When HDFC Limited owns HDFC Bank, HDFC Insurance, and all of these companies, it has to maintain capital adequacy after removing all those assets from its capital. So once the multi-layer holding company structure is removed, at least to the extent of their owning of HDFC Bank, some capital gets freed up. That is one. Secondly, arguably their cost of funds will be lower given that they have access to low-cost banking float funds and low-cost bank FDs as compared to the company FDs that they would raise money from and NCDs. There will be some other things like having to maintain a SLR, CRR, having some priority sector lending requirements and stuff like that. People have been negative on that aspect. I don't think that is so much of an issue because even now SLR yields are somewhat higher than the deposit rates that they are paying. So I don't think that is so much of an issue. Priority sector lending, I think they can manage. CRR, again, not so much of a big deal. So all in all, I think it would be beneficial for the company longer term. Post-merger, there will be some merger expenses to account for, some HR integration expenses, some system integration expenses. So maybe 6 months post the merger will be tough. I think after that, things should be fine. And it's part of the same group and they have had more or less the same culture and they know this is coming up and they have had a long time to prepare for the transition. I don't think there's much to worry.
The next question is that discount brokers like Angel One have been gaining market share as compared to companies like Motilal Oswal, MOSL, which has been an underperformer relative to the industry. What then is your investment thesis for Motilal Oswal Financial Services? Are we comfortable with their lending business? Somewhere around 2019, they had a gross NPA of 9%. How does that compare to IIFL Finance?
Sure. So Motilal Oswal Financial Services is a basket of businesses that are there in the listed company. So one is the retail brokerage business, the other is the institutional brokerage business. They have the mutual fund business, they have the PMS and alternatives, PMS uh, and private equity and things like that. They have investment banking, and they have the home loan business that person is referring to. Overall, the market has been moving, or the discount brokers have been gaining share. So the likes of uh, Zerodha and Angel One and Upstocks and various other discount brokers have been gaining share in terms of especially the new customers signing up and the tech savvy customers signing up. And plus, even from traditional or the older investor base, they are getting market share. On the other hand, what is happening is the traditional brokers, the uh, voice plus digital brokers or phygital brokers as they are called, over there has been a massive consolidation drive that is happening. So small brokers who cannot afford the compliance costs with the increased complexity and uh, increased complex compliance that is to be done, they are increasingly becoming sub brokers of the larger brokerages. So in this consolidation drive, people like Motilal Oswal and all have been gaining on the brokerage side. So that is as far as the retail brokerage goes. So while discount broker has been gaining, these people have been consolidating, and these are one of, I think this brokerage would be one of the brokerages which would be there after the consolidation phase is over. Institutional brokerage, of course, there's no such trend. They are among the big institutional brokers in India. That continues, and again, there the pedigree counts in terms of the number of years they've been covering various companies and sectors and all of that. Uh, they are reasonably large in their mutual fund piece, but more interestingly, their PMS piece is larger, which is a higher yielding business for them. Uh, Private equity has the PMS and the private equity not only gets them the fixed fees but also the profit sharing or carry as it's called. So those are high margin things. So one cannot do a like for like comparison in terms of market cap to AUM, because someone who has a large fixed income kind of AUM versus someone who has a large PMS and a private equity AUM, you cannot directly compare. So that is a very profitable piece for them. Housing finance, again, mixed feelings. So I don't know whether it will be a huge success, some kind of a failure, or a moderate success. I don't know. They have taken corrective actions of the past problems that you have mentioned. Currently, the balance sheet looks clean. They are confident of it and they are pursuing it. The good part is that the founders have their personal wealth tied up in the company and in its schemes. So it's not that they would pursue a business activity even if it does not succeed. So if housing finance shows signs that they should not be in the business, I am sure they'll take the appropriate action as and when required.
Now, there are two related questions on BFSI, but omissions rather than commissions. So, one is to do with insurance. Penetration levels for insurance, general and life, are still very low in India. What are your views on the sector, and why do you choose not to have any direct investments in this industry?
So, in things like insurance and in things like asset management, uh, in the value chain, there are two large set of players who capture some of the value. So, in asset management, it's the asset management companies and the distributors. In insurance, it's the insurance companies and the agents. So, when we own the parent company, we get to participate on both sides. So, if we are owning a ICICI Bank or if we are owning a HDFC, we own the insurance company as well as we participate on the distribution side of the things. Penetration levels are low, yes, but the valuations of the listed companies have been accounting for that and more. They have never really been that cheap or very at valuation levels which would excite one very significantly. So we are watching that space. It's interesting, but we are participating in that. One is through our holdings in uh, ICICI Bank, in their insurance company. We own Axis and we own the mutual fund and indirectly their insurance piece, not a wholly owned subsidiary, but their insurance associates. Now we own HDFC Limited, so we'll participate in the insurance part as well and the asset management part as well. And we own Bajaj Holdings, where we have participation in Bajaj Finserv, both on life and general.
So the related question is again not buying asset management companies. Do you want to add to that or?
This should suffice. So we, yeah, when we own Motilal Oswal, it's owning a asset management company among one of the businesses.
So the next question is maybe a fun one for Neil. When do you plan to list PPFAS?
So one thing is we really don't need to raise money. So right now, but we've given ESOPs to our employees and colleagues, and those will hopefully those will come up. You know, people will need liquidity in a few years' time, and so nothing right now. But we're keeping our options open, and maybe in a few years we could see a listing. Yeah.
Okay, so I'll turn to auto now. What are your thoughts regarding the electrification story in the automotive industry? And do any of the portfolio companies participate in this story?
So on the electrification story, so coming to the portfolio positions that we have Bajaj Auto through Bajaj Holdings and Hero Motocorp directly, and then we have Suzuki, the global company. So all of these have been developing electric vehicles at the back end, and some of them have launched some models. Hero also has investment in Ather Energy, which has electric two-wheelers. Plus, now they have launched their own two-wheeler recently. So all of them have been developing their vehicles. The trend has been incrementally shifting towards EVs, but still EV as a part of the incremental sales is still very, very low. So the penetration will increase gradually, but at the same time, we have seen that as the charging network improves over a period of time, we'll see more and more EV sales globally as well as in India. So we are tracking it, and the existing positions are developing electric vehicles at the back end, but we are tracking it more as a competition to the positions that we already hold.
So Raj, there are two questions on Hero MotoCorp, which is a portfolio company. The first one is that Hero MotoCorp has been continuously losing market share for several years and even lost their number one position to Honda recently. They have had no growth for several years now. So, what gives you the conviction to continue holding this stock?
So Hero has been losing market share on the scooter side as well as on the export side. Whereas if you see the motorcycle side, they haven't lost market share that big. Uh, Honda has taken over Hero as the number one player, mainly because of the scooter sales that they have done in the recent years. So Hero has seen a double whammy over the last 3-4 years. What has happened is that the sector has gone through its own turmoil, plus the company hasn't done well on their own part. So on the auto sector overall, we have seen the demand slowing down over the last 3-4 years, plus the regulations changing, which have been increasing costs, and at the same time the raw material prices increasing, which have had an impact on the margins that they have been earning. So on the overall auto sector as well, there has been demand slowdown, so that has impacted Hero and the whole auto sector. Plus, on the scooter side, they have been lagging behind the market players, mainly Honda and TVS. And on the EV side, also they have been lagging other players. So, yeah, the business hasn't been as per our expectations, but we hope that with the strong balance sheet, with the dividends that they have been paying, it will pay out sometime in the future.
So the next question is also on Hero. Several questions have been raised regarding the corporate governance of Hero MotoCorp, given the findings from the income tax raid on their offices recently. As a fund house, we have always wished to invest in companies with good corporate governance practices. So why do we continue to hold this company despite the recent findings, and how have we made sure that the problems are not deeper than what they seem?
Yeah, I'll take that. So I'll talk about Hero and I'll talk about some of the other companies where uh, allegations get made, where sometimes some findings come out, and uh, where one has to decide what is to be done. So you have asked about Hero. I'll also talk about, let's say, Sun Pharma, or I'll talk about ICICI Bank, or things where such questions come up. So there was this news story first, then there was a press release by the income tax department, which described the company they had raided without naming Hero. It seemed almost certainly to be Hero. That was the press release that income tax department put out. Then there was the clarification that Hero Group gave to the exchanges, and the press release that Hero Group came out. And after that, silence. Nothing. So no news from income tax department, neither from the Hero Group. Similarly, there was a big hue and cry about some whistleblower writing letters on Sun Pharma to SEBI and all of that. Newspaper articles. Then there was maybe some practices were not that great, which needed to be changed, but nothing very substantive was found out in the SEBI investigations, and no substantial orders were passed. There have been things, the earlier CEO of ICICI Bank was arrested, and then a new CEO was brought in, and there was a cleanup that happened over there. So periodically in companies that we own, there will be something or the other that will be either being alleged or sometimes being proven. So what responsibility we have is that we have to keep track of these things that happen. Wherever it's a professionally run company where the management can be changed, we have to be supportive of all actions which are shareholder friendly and which improve the organization. So, for example, were allegations in NSE, and they have a new CEO, and there's been management change. Same thing happened in ICICI Bank. So those kind of things happen. We can push, and we have an obligation to push via the stewardship responsibilities that have been given to us by SEBI, that we have to push for changes at the organization level in terms of the practices that they have and stuff like that. And finally, if we feel that we are not in a position to do anything, and there's a proven wrong that has happened at a company, and the company is continuing to do that, then there's no option but to exit that company. So here, specifically in the case of Hero, there has been precisely one press release from income tax department which does not name Hero, but which seems very much like Hero. There has been a press release, there's been a exchange intimation by Hero which denies that, and after that I am not aware of significant orders that have come about. And in any case, we'll be watchful, given that this news story is there, we'll be watchful of what happens.
The next question is on Balakrishna Industries. So Balakrishna Industries has seen significant correction in recent times. However, our allocation to the company remains below 1%. What is the reason for the low allocation? Is it due to low conviction?
Yeah, significant correction means about 20%, which is not significant. But traditionally we have seen Balkrishna Industries doing well on the off-highway tire market. They have gained market share globally. We like the business, we like the management, we like what the company has been doing. The only problem has been on the valuation side. They have been trading slightly above what we would have liked, and that's why we have not been adding to the position. That's the only reason.
The next question is that we hold both the major two-wheeler companies in our portfolio, Hero and Bajaj Auto via Bajaj Holdings. Is the investment essentially a sector bet on two-wheelers, or is it due to the merits of the individual companies?
Yeah, so different spaces have different characteristics. So I think Buffett and Munger have also discussed this, saying that some sectors do well in certain countries and not in some other countries and stuff like that. So for example, in India, in paints, it's a very high margin, very profitable space, and there's not too much price competition that happens in the marketplace, and all companies do reasonably well. So Asian Paints and Kansai Nerolac and Berger and all these. Similarly, in two-wheelers, typically you have the companies which are cash rich, which don't have a lot of debt. A lot of the manufacturing is via ancillaries, where they mainly do designing and assembly work, and where payout ratios are strong and things like that. So these have been relatively attractive companies to own. Contrast that with the four-wheeler space in India, for example, where a company like Tata Motors has huge amount of debt on its balance sheet. So although they are doing quite well in the marketplace in terms of having a good slate of EV products, and where customers are picking up and they are gaining market share in some of the segments, but the balance sheet does not give you comfort to invest. So it so happens that in the two-wheeler space you have somewhat better balance sheets in the auto space as compared to some other spaces.
A slight detour back to BFSI. So next question is, in our portfolio we have ICRA, but in the past years CRISIL has been doing well on all operational and growth parameters. So what is the rationale of holding ICRA?
ICRA has been a long-term holding. As I said, it's a residual position now from the time we had earlier. From a very, very competitive rating marketplace, where newer and newer rating companies were coming up, and there was price war, and not only price war, there was a ratings war, where the company willing to give the best rating would get the assignment, and people would keep on lowering and lowering their standards. And now that a regulatory crackdown has happened, where some of the agencies with bad rating practices have been asked to shut down, I think that thing is going back. So I think ICRA and CRISIL, or Moody's and S&P, globally it's more or less a duopoly kind of thing. So owning one over the other, I don't think there's too much of a difference, and growth rates over time may one may do well, other may do well at some other point in time. Also, after acquisition by Moody's, which was much later than the S&P's acquisition in CRISIL's case, so Moody's and ICRA have some catch up to do in terms of the other services, non-rating businesses that they can ramp up in India, because that has been the better growth business in India so far, non-rating business. I think that's where ICRA has lagged somewhat, and possibly they can do some work. Again, even in ancillary activities, for example, valuation of mutual fund debt securities. Again, most places you have both of these players coming up and carving up the market.
Historically, our investments in banking have been restricted to the larger banks only. However, there are several smaller banks which are consistently profitable since 10 years and are available at valuations lower than their book value. So why do we continue to invest only in the larger banks?
So banking is a business where, let's say on a shareholder net worth of 8 to 10, you will run a balance sheet of 100, and sometimes there may be uh, contingent liabilities also. So it's a high leverage business. And in a high leverage business, apart from uh, the credit quality and the credit processes, what also matters is the diversification. So we get asked this question often: why don't you buy, let's say, a microfinance company? Why don't you buy a gold loan company? Why don't you buy this smaller bank which is uh, very strong in this southern state? Why don't you buy this uh, regional bank here? See, what happens is, even if the management quality is good, and if the credit processes are good and the balance sheet looks reasonably okay, what happens is that in a downturn, if that particular region suffers, then that bank will also suffer. And because it's a very leveraged business, then there will be a big impact. So we saw this in microfinance companies in Andhra, for example, where there were a spate of suicides because of crop failures, and then the government cracked down heavily in terms of their recovery practices and all of that. So we want to stay away from this. We prefer the banks with scale, where they can invest in appropriate technology, because technology is a big item of expenditure. Having the right kind of core banking solution with the right mobile apps, good user interface, and all of that, having a full suite of products in terms of credit card, insurance, stock brokerage, mutual fund, all of that helps. So our preference is for, you are right, for somewhat larger companies with good balance sheet strength, and the geographic diversification and product diversification.
The next question is for Ronak. Most of our foreign holdings are in the technology sector, which Rajeev explained in detail. However, a majority of the high quality R&D is happening in global pharma companies. Have we considered investing in such companies, or are we at least tracking it? If no, then why?
Problem with R&D companies is many times they don't have a existing cash flow which will support the R&D over a long period of time. So most of the old products which are launched, they will have a patent regime. That patent regime over a period of time will end, and that company will lose the pricing power that they had for that product. And within that time, they have to reinvest some of the capital into doing R&D. So per se, it's a great idea, and companies can do it at scale, but the guarantee of success is not there. So most of these are in a way like venture capital bets, where we don't know whether new products will succeed or not. We have to probably assume that they will have enough products available in the pipeline which generate cash flows for them that can be put into R&D, and that R&D can have some fruitful nature. On the other hand, if you look at generics, which is what we own, it is already an off-patent product. Their development probably will be into how the drug is delivered rather than how the drug actually is created. So in creation, it's a high capital intensive business. Over a long period of time, there is no guarantee of success. And who succeeds can do very well. So we have seen great successes, but they are very few and far in between. So instead of going into a niche pool of a small number of players with no certainty of outcome, we chose to have a safer route by using generics as an investment process.
Now we come to everyone's favorite question or favorite stock, which is ITC. So the question goes, ITC continues to remain our highest conviction idea, one of our highest conviction ideas. However, the ITC management seems least bothered in any kind of value unlocking. Keeping this in mind, why do we continue to invest in ITC?
They have announced that they may consider spinning off some things, and again, I don't know what this thing about some companies are loved because they diversify, and some companies are hated because they diversify. Some companies get a huge holding company discount. Some companies don't seem to be getting any holding company discount. So, like the largest market cap company in India is Reliance, and which was a petroleum refining company and petrochemicals company, and it went into telecom, and people are okay with that, and went into retailing, and people are okay with that. And if ITC has a tobacco business plus a new FMCG business plus something, then they are least bothered about value unlocking and things like that. So these are narratives. So I think we are past the peak meme season in ITC that happened 2 years back. So today we are in the residual area. So now that stock prices done reasonably well in recent past, people are not so bothered about value unlocking. In fact, the most hated aspects of ITC, which is the hotels and all, actually have become the reopen trade. So now that people have started moving around, hotels are uh, in flavor. So which is okay. See, the thing is complicated. It's not that suddenly one fine day the CEO or someone in ITC can say, okay, now all the companies are separate. There's a big holding by uh, British American Tobacco. There is a big government of India holding via Suti. There is a big holding by LIC and other institutional investors. They take everyone on board and stuff like that. But they have said that they are open to discussions on this, and they are exploring various possibilities.
Right. So as I said before, you often get the same question and then it's opposite. So the opposite is that recently we had to trim our position in ITC because it had come close to breaching the 10% mark. If we have to keep trimming our position every time it comes close to 10%, do you believe this is disturbing the compounding process?
Uh, yeah. So it's true that no company will become 25% of the portfolio or 30% of the portfolio kind of thing, that we'll keep holding it irrespective of how big it becomes as part of the portfolio. So the regulation is that after a stock becomes more than 10% of the portfolio on account of price movements, or not because we did anything, but because of market movements, it's called a passive breach. And we have 1 month's time to rectify that, which is bring it back below 10%. So we get 1 month's time. It's not that we have to do it on day one, but again, it's to be done. And if not, then we have to justify why we did not do that. And that typically will be because we could not sell it, or it was illiquid or something like that, which is not the case here. So uh, the flights of fancy that people have, oh, I'll buy 3 stocks and or put 40% of my net worth in this one company, and that will go 20-fold, which is the folklore, right? Buffett buying 40%, putting 40% of the partnership assets into American Express and stuff like that. That will not happen in the mutual fund.
So Rajiv, I'll give you a bit of a break from ITC and come to Ronak. Why are we not considering Apple in our portfolio? It does buybacks, dividends, everything that a value investor can ask for.
So we did consider, and we did used to own Apple in the portfolio. In fact, when we were buying Apple, incidentally, a news broke out while I was buying that Mr. Warren Buffett was also buying the stock, and the stock promptly went up. And after that, I think we almost sold at double. LDC doubled, and Apple doubled, and we sold Apple. The Freudian slip. Apple doubled, and we had to exit because electronics product business, essentially that valuation is a dangerous territory. We have base rates saying that product businesses don't last long. Of course, history has proven me as a technology analyst wrong, that products can do well and services can become a big part of cash flow, and they can continue to become bigger and bigger. So it's a missed opportunity that way, but we used to own them, and we still track it.
I'll at the risk of sounding completely stupid, and probably this won't age well, meaning when people and this is recorded, and after 2 years people will say you said that and that was very stupid of you to say. I'll say that in my mind, Apple is a vulnerable company. This is a personal opinion. Uh, it's a company which I don't know why it is not uh, at the center of antitrust uh, for various people, for various regulators in various countries. Just imagine if Microsoft were to tell you that when you do any transaction on your laptop, on a browser, that you have to pay a tax to Microsoft for everything that you do. Uh, if that were the case, then people would be crying murder, and people would be asking for Satya Nadella to be put behind bars and stuff like that. Whereas the situation is that on the App Store, whatever you do, whenever you do a subscription or pay some money in a game or do whatever, 30% tax is to be given to Apple by the app developer. Now, I don't think that is justified, and that is one big source of revenue. The other source of revenue is they get money from another of our portfolio companies, Alphabet, for being the preferred search engine on the uh, Apple ecosystem, which again is a anti-competitive, although it benefits us, but it's anti-competitive. Third thing is that they, in the name of privacy, they harmed all the apps and including companies like Meta and all. And now they are launching their own advertising service. So if it was just the first part, one could understand that they are in favor of privacy. But here what they are saying is, we will provide you targeted ads because we know everything about our users, but we will not let anyone else do that, which sounds completely hypocritical. And people may not stop watching YouTube, or people will still take Uber rides and use Google Maps and Instagram and all that. But in a recession, among the first things to be cut are discretionary items of expenditure. So, Apple, again, if you have been a Apple user of let's say a MacBook Air or MacBook Pro or iPhone or any of their products, each time the product comes up for replacement, the price is significantly higher than what you bought it the last time round. So I had a MacBook Air which I had bought for, let's say, 65,000. Today, equivalent, I would have to probably pay 1 lakh or 1 lakh 20 for replacing with the current model. I think it's been price gouging its customers repeatedly. Uh, Although numbers look great, I'm not a big fan of the business model and the company. And I know probably this won't age well. Thanks.
So the next question is for Rukun. One of the recent additions to our portfolio was NMDC. Can you please explain the rationale behind this investment, especially when iron ore prices are at multi-year lows? And also, how do you plan to deal with the ongoing demerger of their steel plant?
So, NMDC is an iron ore mining company, and what they've done over the past 10 years is that they've taken the cash flows that we're getting from the iron ore mines and used that to build a 3 million ton steel plant. And they are in the process, when we started looking at it, they were in the process of demerging that steel plant. And if you look at it, the market cap was close to around 32,000 crores. And on an average cycle basis, the iron ore mining operations would give them about 3,500 crores of cash flows. Could give them 2,000. That could give them an ability to give 2,000 crores or more of dividends back to shareholders. The prices do end up being cyclical, but we'll tend to look at it on an average cycle basis, and we think that 3,500 crores of cash flows was reasonable. So overall, the markets are valuing the business purely for its iron ore mining or assigning a very low valuation to the steel plant. And If you look at the steel plant, they've spent close to around 20,000 crores or higher on creating that plant. So even if you ascribe a valuation similar to what SAIL has, let's say a 0.5 times price to book, there was some upside to that, to the valuations that market was giving it. And there are reports that government might want to privatize it. If that happens, it can be a higher upside. But even if it doesn't happen, you have some upside even at just like sales kind of price to book multiples. So to us, it has been like an opportunity with a limited downside and possibility of a reasonable upside. We'll see when the demerger is now done. The steel plant entity is yet to be listed. We'll see where it lists and what kind of valuations it gets, and then take a call on what to do with it.
Yeah, although we did not classify it as such as a special situation, it's more or less a special situation. The reason not to classify it as special situation is if we did that, expectation would be immediately post demerger we would be selling both the components. But essentially we got one for free. The iron ore piece was the only thing being valued, whereas 20,000 crore steel plant was available for free.
Next to the strategy question, and an interesting one that we also covered in Mint actually. What have your learnings been from the covered call strategy so far? Has it worked well for you? Maybe you can speak about the learnings from covered call trade on Coal India as well. And who in the team is responsible for covered call strategies?
Yeah. So in the covered call, the thing is that it's not something we would do all the time. Bull market, bear market, bombed out market, euphoric market. It's not that we'll do it all the time. Whenever markets are reasonably priced or somewhat in the elevated territory, there we sell what are called out of the money options, not in the money. So if a stock is, let's say, available or trading in the spot market at 100, then we may say 100 and sell 105 strike price call options. Now, one of two things can happen. Either the stock price remains below 105 or it goes above 105. So if it goes above 105, the options that we have written get exercised. So if for that 105 option, let's say we have got premium of, let's say, 1 rupee, then effective sale price becomes 106 or 105 plus that 1 rupee. So a small part of the portfolio holding gets sold at that elevated price. Now, if the price falls again, we have the opportunity to buy it back at a lower price. What we do is, see, if we are writing out of the money call options at 4% or 5%, on an annualized basis, that comes to around 48-50% kind of annualized returns. Now, those are like selling lottery tickets. Very low probability. Once in a while, someone will get it rich. But on an average, the option buyers lose money because the options expire without being exercised. We'll do it across a portfolio as and when we find opportune times. So, as we had said at the time of introducing the call options itself, that one, we can write it only on Indian stocks. Number two, we can write it only on index stocks. Number three, we can write it only to the extent of 30% of our holding. And number four, maximum is 15% of our overall portfolio. So it will never be a very significant mover of the needle one way or the other. It's just that instead of doing something like, let's say, cash to futures arbitrage, where you may get 6% per annum kind of return or thereabouts, this does much better in terms of offering you returns.
So Neil, one element of the IPO question that got missed, I think. Can we expect any quota for unit holders in the IPO?
Honestly, you've not like really thought through an IPO or anything right now. You just asked me the question. So I think those could be future plans. We're not even sure if it's going to be a future plan. So once we actually decide and finalize that, oh, okay, we are going for an IPO, maybe then we can figure out nitty-gritties and see where it goes. Honestly, I haven't really thought about it. So don't know right now. We'll figure it out when we get there.
The next question is about the stock picking in the conservative hybrid fund. So, what is the rationale behind selecting stocks in that fund versus the flexi cap fund, the kind of differing strategy?
Yeah, one part that got missed out earlier, so who does this monitoring? So Rukun in our team is the person who does monitoring of option premiums, implied volatilities, of uh, running various quant screeners to see if we are missing out on some opportunities somewhere, or to figure out if there are some warning signals in our existing portfolio companies and stuff like that. So apart from his understanding of fundamental research, he also does this quant stuff in our team. Yeah. In the conservative hybrid fund, the approach is more towards cash flow generation for unit holders. So we would not be buying, let's say, a Amazon or a Alphabet or kind of company here. Here the emphasis is more on dividend yields, low multiples, range bound stocks where the downside may not be very high. So the approach is more towards cash flow. Sometimes you get good cash flow plus growth prospects, in which case it may be in both schemes, but otherwise it's more oriented towards cash flow.
In the tax saver fund, Bajaj Holdings and Maharashtra Scooters combined for 14.4% of the portfolio due to the recent run up. Is this not too much concentration for a single group? What is our sell discipline in such a situation?
Yeah, that again comes to the opposite question. So one question was, does it not impact the compounding process? Now the question is group concentration. So yeah, so yeah, it's 14% in a group. There's no denying that, but it's two different businesses. So one business is auto related, the other business is financial services related. So we have exposure to both. So to that extent, there is diversification.
There are multiple questions on IEX. So I'll kind of give you all of them in one bunch. So IEX has been a strong performer for the fund in the past, but has now witnessed a sharp correction. The recent news flow has also been quite negative, and competition also seems to be intensifying. With this context, despite it trading at a multiple of 100x at peak, why did we decide not to book some profits in the company? Also, can you elaborate on what your sell triggers are? What remains your rationale to continue holding this stock? Can you please talk about the rising competition for the company and how that will impact growth?
Sure. So IEX we had bought at much lower levels, and the stock price ran up very fast in a short span of time. The argument can be made we should have sold off at higher levels, or when valuations were very, very expensive and things like that. What happens in small and mid cap companies, or in smaller companies in general, where the business is at a nascent stage, is that the base effect is very, very strong. So just look at PPFAS, for example, just as a very, very random and tangential thing. Growing from a asset AUM of 300 crores to 600 crores is relatively easy. But in percentage terms, it will look like a doubling. Going from 600 to 1200 is again a doubling, but that's a low base effect. For a SBI mutual fund to grow from, let's say, 6 lakh crores or whatever their AUM is to 12 lakh crores, that takes a lot of effort because the size is very, very large. So the power trading market in India, the exchange traded power in India is at a very, very nascent stage, and there are various aspects to it. So uh, you'll have various segments coming in over a period of time. You'll have a market for renewable energy. You'll have a term market. You'll have a day ahead market, and various kinds of contracts will be there. So given that the whole trend is towards renewable energy, which is intermittent in nature, given the whole trend towards uh, traded power instead of long term power purchase agreements, the current reported profit after tax, and just comparing the market cap with that and saying this is the PE and now PE has gone up, so it should be sold, that did not seem appropriate to me, at least. Uh, did we buy at that valuation? No. So our purchase was much lower. It ran up very, very significantly in a short span of time. But the overall attractiveness of the sector of the space is looking quite good. Said we'll hold on. It's uh, again a company with or an area with network effects and stuff like that. Competition, sure, other players have entered. Competition becomes easy when there's a fixed price, right? So the ceiling price of 12 rupees a unit was announced, and a lot of power started getting traded at 12 rupees a unit. Now, if the buyer and the seller both know that the price is going to be 12 rupees, then it's easy to do it on any exchange. Uh, I'll give you example from the stock market space. Bulk deals typically get reported on BSE, right? The buyer and seller both know the price. They coordinate the buy and sell order entry, and it gets smashed on the screen. Whereas most of the price discovery happens on NSE. So when power starts to trade at 12 rupees, there is a loss of market share for IEX. Otherwise, they are, to my mind, looking at the numbers and trends, I would think they are somewhat of a leader in the price discovery aspect. Will they be a monopoly forever? No, there will be other people who will try to compete with them, sure. But it's a area where in the power market in India, number one, has to account for current power consumption and grow at a normal rate, let's say 5, 6, 7% to take into account normal GDP growth. Plus the transportation from petrol, diesel towards electrification, that will add a whole lot of power requirement to the uh, whole power consumption and trading area. Now, increasingly, the power plants we are setting up are not the thermal power plants. Increasingly, the whole focus is on renewables, on solar, wind, and stuff like that, with energy and green hydrogen and all of that. Now, with that, the overall quantum of uh, traded power in India over the years should go up, I would think. Time will tell whether we should have sold off at a higher price and then again waited for a correction or something like that. But overall, the company looked attractive. And given that we have not bought it for a significant amount of time and we have been getting additional flows, the weightage has been coming down in our portfolio over a period of time.
There are two questions on the conservative hybrid fund. One is, a recent RBI report stated that some states are over levered. What is your outlook on state development loans? Because that's the bulk of conservative hybrid funds portfolio. And the second one is, why don't we invest in AAA rated bonds of private companies? Won't the returns from the fund be higher in such a case?
Yeah. So we are live streaming this event, and the recording will be up later on. In the comment section, we will post a link to one of the documents where the SDLs have been discussed and how these are sovereign rated, and they are effectively RBI treats them as default free. So these bonds are serviced by the tax collections which happen. So GST collection primarily, and the share of states' share of taxes in income tax and other taxes. So if these bonds were to default, then all bets are off. So the banks, the safest banks that we talk about, let us say HDFC Bank, Kotak Bank, SBI, these are big holders of SDLs, insurance companies, uh, employees provident fund organization. Even for a long period of time, uh, the national savings certificate and PPF and all small savings that we would do, bulk of the money was going towards financing states. So as per the financial system that we have in our country, both central government borrowings and state government borrowings are treated as at par as far as the statutory implications go. So both are eligible securities for uh, provident funds, insurance companies, and likes of that. They are SLR securities. So against the statutory investments that banks have to make, they can buy these bonds. About yields, the funny part is actually these yield higher than AAA rated corporate bonds. So even though they are sovereign rated and risk free, they trade higher than corporates which carry a default risk. So that's the reason to invest in them.
So it's almost 5. How much time do we have before we invite maybe one or two last questions?
Maybe we can go till 5:15. Then we can take live questions, and if we fall short of live questions, then we can again resume it.
Sure. So, Neil, some unit holders are hoping for an expansion from PPFAS. What are your thoughts about launching a new fund in any of the following categories? Pension fund manager of the NPS, arbitrage funds, small, mid, large cap, equity savings, NASDAQ index fund. Now, the last is interesting because there is still in the overseas limit, there's a separate cap for index.
So like I mentioned that as of right now, there are no plans to launch any new schemes. Obviously, like I said, if we think there is some differentiation, we can do something different we can do within that scheme. It's just not a run-of-the-mill kind of a scheme, and if we can provide value to the investor, and like I said, if we ourselves are excited to put our own money in it, I think that's the time to probably think about launching a scheme. So, for example, let's go back a little while back, and again, this was during the conservative hybrid fund, and we were talking about it, and that time the conversation was that if we have so there are older people in our families or friends or something, and they were asking us, okay, what do I do about my retirement? You guys have just these three, but what if I need to do my retirement savings with you guys? What should we do? So that got us thinking, and we figured out, okay, a conservative hybrid fund would be a great thing. Like no one's really doing too much in this space, and we think that this could actually add value by not taking any credit risk and still giving decent fixed income returns, better than probably FDs and stuff like that. And people can do an SWP or systematic withdrawal after 3 years. So that's where it got started, and we thought, okay, this seems interesting and we can do it. One thing we're not going to do is just launch schemes for the sake of launching schemes, So again, we'll think through it, and if something feels that if we think that's something we need to do, we will definitely do it. So it's not like we are closed that, oh, we're not going to launch any scheme, we're just going to do this. But yeah, I think if there's some interesting opportunities that come our way and we think that we can actually add value to our unit holders doing this, then surely we will add a scheme. But as of right now, there's no plans to launch a new scheme. And sorry, you asked about the NASDAQ ETF, right? So again, I think one thing is that I think there's a 1 billion limit for the ETFs. And again, what we're hearing probably from the industry and all that, it's probably also close to getting full, or the quota will probably get over sooner than later. So I think for us, it's like, again, we've said that we are active managers and we'd want to stick to that space instead of going probably the passive route for right now. So we are okay to wait a little bit longer for RBI to probably open the limits, and I think it's probably a matter of time that the limits will be opened up. I don't know how long it will be. Like we have mentioned, me and Rajeev, that as the macros get better, macro factors get better in the world and things start to probably get to a new normal, I think we'll probably have some opening of the overseas limit. So we're okay to wait until that happens.
On a related note, there's a question about, is PPFAS planning to offer a PMS scheme for HNI clients in the future? This goes back to the roots of PPFAS, which was a PMS at one point.
Yeah, so we still have a PMS license going. So the PMS license is there. Right now, what we are saying is that the PMS will probably start accepting money in the PMS only for NRIs or residents of US and Canada, and not for anyone else. So we do have about 12 clients still in PMS, legacy clients who are American or US or Canadian based. And the reason for them, it makes more sense for them to invest in a PMS due to their tax, because of taxation and other hassles. So what we are going to plan to do is we could open it up for HNIs in HNIs in the US and Canada, and we'll stick to that because again, anyone outside that can invest in the mutual fund. There are restrictions of investing in a mutual fund from US and Canada, and we think the mutual fund is probably a better route for these people to invest into PPFAs. But in Canadian US clients, they don't have much of an option, so PMS will probably open it up for them.
So research approach is the same. The mutual fund is a far more efficient route for anyone else. Capital gains are taxed only at the time of redemption, not on each transaction that the investment team does. The annual expense ratio will be much lower in the mutual fund. So I see no logical reason for anyone apart from US or Canada residents to choose PMS over a mutual fund in our context, kind of thing. Why US and Canada, why US people should choose PMS is because otherwise they would be taxed on unrealized gains in a mutual fund on an annual basis. That's their tax law for offshore mutual funds. So it's a peculiarity. Otherwise, I think in terms of economies of scale, in terms of lower expense ratios, better tax laws, a mutual fund structure is much better for investors. That's why we are not looking at offering it to other people.
So Ronak, I have two fun questions for you. The first is your views on Berkshire Hathaway as a stock.
So what can I say about Berkshire Hathaway? It's a fantastic business run by fantastic management, and over a period of time they have built a series of portfolio allocations in different sectors which keep generating cash flow, which keep generating investment float for them, and which gets redeployed at opportune times. At any given point they will have a huge cash balance available to invest, and whenever markets correct they can take very very large positions or even sector allocations which most other investors don't take. So from that point of view, it's a great company to track. We learn a lot from their history of allocations, their sharing of knowledge to the investors. But as a stock, it has been difficult to own because the kind of sectors they invest in, they are dominant sectors in say utilities. Apple is a different example. It's a large position for them. They are also invested in banks. Some of these ideas are better in our countries to own, in my view. So Berkshire did not come up very high in that regard. Interestingly, there have been times when the book value trended very close in terms of getting a discount to the underlying values of the business. So that was interesting time to probably buy it, and many I think investors have bought Berkshire on that basis only. I think it remains a great company. I track it and learn from it, but I think we can find better opportunities in our geography to invest in the same sectors.
So we'll end on a blockbuster question before we move to live audience questions. Ronak, for you again. your views on Elon Musk's acquisition of Twitter and Tesla stock. So Twitter is now private, but any thoughts on that? And Tesla, of course, is traded.
So because Twitter is now private and it's owned by Elon Musk, I would not want to comment on that because I want to be on Twitter and enjoy the FinTwit conversation on that. On Tesla, so again, it's like, okay, we missed the opportunity to buy it, but why did we miss it is more important. When we track auto companies, there is a history of consistent cash generation, consistent operations over a period of time, and scaling products in a particular category. In a category like electric vehicles, when Tesla came out of nowhere, not out of really nowhere, they have been around for a while, but manufacturing at scale is something that they figured out very recently. That is, even after the stock price really went up, the manufacturing at scale was still picking up. It was not a known entity in terms of probability of success and will keep doing well. After that, you have seen almost all auto companies in the world who have capability to manufacture at scale. They have come up with their own products. Now we don't know whether which products will do well in which geographies, whether incumbent players will have better products, or whether Tesla will do well continuously. So as a product, it has had won accolades. It has won great regards from people. Customers love the product. On the other hand, there are other issues where it works in certain geographies better and doesn't work in other geographies in terms of price points, in terms of the charging network, and the overall EV ecosystem that they are trying to create. So as a business, it is not a proven thing yet. It needs to have a long history of operation. I mean, just to give you context, some of the auto companies have 100+ year history. So you can actually go back in time and read the annual reports and see how the companies have scaled, failed, and did whatever they did. So in that case, I'm not saying this can have a 100-year history. Should not be unfair to a newly launched technology. But we keep track as a academic exercise to see what other people can do better, and that's, I think, a better way of looking at it. But as a stock, it has been crazy volatile, and as a business, it has not proven itself to be a steady cash generation capacity over a long period of time.
So can we move to live audience questions now?
There's a mic in the front. You can come up and ask a question.
There's one behind also.
Whichever is closer.
There's one behind also, so wherever you guys are.
Hey, you could come here to this mic and ask a question.
I didn't just. Oh, sorry.
Hello. Are we missing out Adani and Ambani's in our portfolio? And also, I think we don't have any Tatas in our portfolio.
Sure. So some of the companies that you mentioned, let's say out of the three that you mentioned, Adani's, Ambani's, and Tata's, we could have a Tata company at some other point in time in the investment portfolio. So we keep evaluating various companies at various points in time, and you could see some of them in the portfolio. But let's say Adani companies which have done really well on the stock market in terms of the stock price performance, if you were to look at the valuations of some of those companies, typically one would not look at them as attractively valued companies at this point in time. So finally we have to buy 25-30 companies which make sense for us. So we may not have every industry house being represented in the portfolio. We keep looking at companies and evaluate based on our parameters of promoter and management quality, business quality, valuation, and all of that. And only when they pass all those filters, we invest in them.
Yes.
TCS is there in the tax saver fund. Yes, please.
Hi, sir. Sir, actually, the slide that you showed of Alphabet, of Amazon, and of Microsoft. Now, actually, sir, you had added PE. Now, actually, they say, if you torture the data, it will confess. Now, if I would ask you to have 3 more columns, price to sales, EV to sales, and price to book to all these 3 companies, even after this massive correction Amazon, you are very bullish, but I can tell you one interesting fact about Amazon. It's the first company who has lost the 1 trillion in market cap. Okay, so now market has figured out that Bezos has gone, just like what happened to the Starbucks. Bezos has gone, so who knows? It was all about the jockey. In India, they are not making any money since last 15 years. So what market has its mind? We don't know. But the point was, if you will add these 3 rows, price to book, price to sales, and EV to sales, the whole picture would have gone. Microsoft, what is 12 times to sell? And Charlie in a meeting told me, gee, if you get anyone buying your family business at the price to sales of 3 to 4, just sell it. Just sell it. And at the price to sales of 10 to 12, your stocks were 6 to 12, and you kicked out Persistent, you kicked out Emphasis at the price to sales of 4 to 5. And you know also that Persistent and Emphasis are going to hit all-time high before then all these things. So the example that you gave of Infosys of somebody bought at 207p. So the kind of the chance that you, because I'm talking in hindsight, so I always benefit, but just giving a much broader picture, US was riding on a 12 years of a bull run. The Buffett indicator, the market cap to GDP ratio, it was 2.5. And the kind of the low interest, rates that they kept, and the kind of the, budget expansion that Fed did, the kind of the, balance sheet that they expand. So writing on the wall was, and every Tom and Jerry, Dick and Harry house was coming with.
Sir, is there a question or is this an opinion piece?
No, sir. Actually, if you are saying,
I get it.
If you are scoffing at it,
just one moment. Do you want me to respond to
yes, sir. Yes,
a question, or are you?
Yes, no. I just want your thought process. How can you justify something to hold? And you had added in 21 Microsoft, continuously. So I just want the rationale of adding something at price.
I got your question, sir. If I can respond, please.
Yeah.
See, we have quite a few questions which are there, and we have to be mindful of the time that we take in asking a question, right? Price to sales as a metric can be applied only for comparing companies in the same sector, right? So you can compare price to sales of Walmart and you can compare price to sales of, let's say, something like a Costco, right? Both will be at price to sale of 1 because both are low margin businesses. Can you compare price to sales of a Walmart with price to sales of a Tiffany? No, because the margin profile is very, very different. So when you are comparing a price to sales of a Persistent and Emphasis with a price to sales of a Microsoft has to write a program once, which is Windows or the Office suite, and the marginal cost of selling an additional license or additional subscriber is 0. Okay? SaaS companies, product software companies, all of them will be at massively higher price to sales. So price to sales, you can compare only for like to like. You cannot compare across different companies. So that is one point on the question that you asked. You mentioned market cap to GDP ratio. So for Live Mint itself, I have a article on market cap to GDP ratio. You can Google it and look at it. Buffett has been using it. He's spoken about it. I think it's a massively overrated ratio for the following reasons. Number one, when you use price to sales ratio over periods of time, there are massive dislocations in terms of the amount of formal economy which is in listed space versus unlisted space. Let me give you an extreme example. Let's take the stock exchange of Saudi Arabia. The market cap to GDP of Saudi Arabian stock exchange prior to Saudi Aramco listing and after the Saudi Aramco listing if you use it across time, we'll say it was massively undervalued before Aramco got listed and it was massively overvalued after Aramco got listed. In India, you have had listings of many companies over a period of time. So at one point in time, TCS was an unlisted company, LIC was an unlisted company. In India, most of the restaurants are in the unorganized space. In the US, you have the McDonald's and the Starbucks, and all of these are listed companies. So comparing it cross-country also is problematic. Market cap to GDP of a resource-rich company will be very volatile. A country which is dependent on petroleum, oil and gas, iron ore, those kind of companies will be very volatile and will have a very different implication versus market cap to GDP of a country with highly innovative companies in software, pharma R&D and things like that. And finally, when you compare market cap to GDP of, let's say you said market cap to GDP of US of whatever number you gave, 2, 2.5, whatever. When you add the market cap of various companies listed in the US, let's say companies like Alphabet, companies like Microsoft, companies like Amazon, do these companies derive all of their revenue and all of their profits only from the US? No. So in most of these companies, US would account only for 40% of their operations. So if you are increasingly the country of listing and country of operations may not have a direct correlation. Today, when you add market cap of Tata Motors to Indian listed market cap, a lot of their business operation is via Jaguar Land Rover. So all of these things are fine to write opinion pieces, which was what your question was pretending to be, but to my mind, if I had to go back and have the same data, I would not have sold these companies. That is my opinion. You can have a difference of opinion with that. You can completely disagree with that, but that's where we are.
And sir, actually, another question on this basket approach. This thing just blows me out. What is the basket approach? Have you seen the delta between the top performing stock of that sector to the not so doing good performance from that same sector? So the delta is getting huge. India is the country where actually it can cater to the 100 plus trillion kind of a world economy in only this particular sector, that is pharma. And if we are not the true player of the game, why we are approaching basket? Just because we are not the true player of the game. So Warren actually, went to that, Ted and Todd, just because he doesn't understand few things. So he got it Ted and Todd. And Ted and Todd actually, pushed him to buy Apple. So, sir, actually, what I'm saying, the healthcare, the kind of opportunity there where India can cater to the world. So having a basket approach, I don't think actually it is at all suits you. Not doesn't good or bad. It doesn't suits you. That's it. And because there are people on Twitter, there's a called unseen value. If you go through his Twitter account, it's a treasure trove. And with the kind of the confidence he talks, with the kind of because he knows the game. So, sir, my question is,
sir, is there a question again? Sir, please ask questions in a sentence with the end of a question mark at the end of it.
Sir,
my request to you is there are various people who want to ask a question. We cannot monopolize time.
Sir, if you find those irrelevant or sentences not connected, I am absolutely wrong.
One or two sentences with the end of question mark at the end of it. Humble request, sir. What is the question?
Okay, now the question, actually, sir, Ronak sir, actually, I believe actually you got the question actually.
No, it was an opinion. You should not have a basket approach. That is your opinion.
Yes.
Is there a question at the end of it?
Yes. Yeah, it should not.
It's your opinion, right?
No,
Thank
sir.
you for sharing it.
Okay, sir. No, sir. What I'm saying, there should not be a basket, approach to this. What you had got to say?
Yeah. So it's an opinion, right? There's no question at the end of it.
Okay, sir.
Or is there a question? I'm not getting the question.
Sir, the fund like us and the opportunity like pharma, actually having basket approach, we are missing something
I'll answer.
on that.
You have not asked a question, but I'll make a question for you and I'll answer that for you. Okay? I'm asking a question for you. Why do you have a basket approach in pharma? That is your question to me. My answer to you is, in pharma, no matter how much research you do, it is impossible to predict whether US FDA will go to a particular plant and find irregularities or not. It is impossible to predict after a warning letter has been given to a plant how much time it will take to resolve that or not. In pharma, each company has dependence on one or two particular molecules in which suddenly there could be a price war which breaks out. No matter how much research you do, no matter how much pharma publications you subscribe to and read, the approvals for certain products come as a surprise to the market, the import alerts come as a surprise to the market, and the per company risk is very, very high. So, price movements of 30% and 40% on a per company basis are not uncommon. They are very, very common. When you have small weightages in a group of companies, that impact on the overall portfolio level becomes lower. That is the reason why we have a basket approach. You mentioned Mr. Warren Buffett. He has also had basket approach in his investment career in sectors. Just Google it. Google it and you will come across that. Thank you very much. We'll move on to the next.
Last question for Neil.
No, sorry, sir. We will not be taking more questions from you. There are other people who will have questions. In any case, there are a lot of online questions which are pending. Yes, please.
Sir, as a strategy, do we totally abstain from investing in IPOs and selling off on the listing date?
Yeah. So there is no hard and fast rule. So, sir, one very good example of a question which just came about. So, sir, there is no hard and fast rule that we will not be investing in IPOs. We have invested in one IPO which I can clearly remember, which is CAMS as a anchor investor. The other IPO that we had invested in was CDSL, where we had got a very, very marginal quantity. At that time, we had sold off and then we bought it later on when the price had a significant correction. So, there is no hard and fast rule. That is one. Secondly, most of the times IPOs come in frothy markets and there's huge promotion behind it. So, I think Buffett had coined this full form for IPOs. It's probably overpriced. So, that is true for most cases, not all. So, again, wherever the company is good and the valuation is attractive, oversubscription is very high, so you don't get meaningful allocations. So, it's not a preferred mode of investment, but at the same time, if something comes our way, we are open to taking positions.
But then our focus is not on earning gains which will accrue on the listing date. That's never been a focus.
So that is more of a speculative exercise. Figure out what the grey market premium is, anticipate what will be the listing price. Sometimes it goes well. Recently, it has not gone so well. So you have seen what has happened with some of the new listings, things like Zomato, PTM, all of these. So some of them have made money on listing day, some of them have not. We don't want to. We are buying companies with a view of owning them for a meaningful amount of time, 4 years, 5 years. We are not looking at flipping them for listing gains. That is not the approach.
One more question, sir. SEBI getting too inquisitive in mutual funds, and of late they've started inspecting mutual funds like anything. So, any observations which they've come up with pertaining to our schemes, whether on compliance or whether on operational aspects?
So, SEBI inspections have been ongoing for a long period of time. It's not that they have recently started. And earlier there was a commentary on pharma things. In pharma, US FDA inspects. Here, SEBI inspects the capital market entities. Just like US FDA keeps increasing standards over time, here also the regulator keeps increasing standards over time. So what was acceptable practice 3 years back may no longer be an acceptable practice now. So they keep enhancing the practices. the inspections can take various forms. So one is we are supposed to submit every month something, or every 2 months. Maybe Priya can talk about it. Something called a cumulative test report, where various parameters are input on the SEBI portal. There is some data which directly goes from the registrars and transfer agents to SEBI in terms of the account holders. There are reports which are sent by the board of trustees to SEBI, the internal audit report, the statutory audit report. All of these go. So various things. So sometimes they appoint CA firms on rotation basis to inspect various fund houses. So all those keep happening, and wherever they see something that can be improved upon, they mention it to the company as well as to SEBI. So it's almost 100% certain that in any report you will not get a situation where there are zero observations. There will be some observation. In this case, the PAN card was captured wrongly, or in this case, the email address was repeated in 3 folios, or some such thing. So there will be these various observations. So, for example, we own Suzuki ADRs. Now, Suzuki is a listed company in Japan, but the ADRs for some technical reason are not called listed securities. So, is that a listed security or not a listed security? So many times some of these small observations keep coming up, but there's nothing significant that is there. If there is something significant, then they take regulatory action, and then that comes in the public domain.
Thank you, sir.
Yes, please.
My question is to Mr. Rajeev, sir. IEX doesn't have a promoter. Is it not a concern to you?
So, sir, increasingly, what are companies in the nature of exchange are called market infrastructure institutions. And in many cases, it is regulatorily effectively prohibited for there to be a promoter. Because a lot of these entities have to be run on a regulatory aspect first rather than profit motive. So if you look at BSE, for example, there's no identified promoter. If you look at NSE, for example, there's no identified promoter. There may be some shareholders who may own 10-15%, but the concept of promoters typically is not there. Depositories, for example. So the objective of regulators themselves is to have a diversified set of shareholders, and the entity has to function as a first line market regulator and has to work for development of the market and all of that, rather than work solely for profit motive. You're welcome. Yes, please.
Hi. So
I'm
very sorry.
Hello, sir. Good evening. Thank you so much for the wonderful insights. I have a simple question to ask. Does your research also includes visiting, plant or factories, or meeting with the management team, or are we too dependent on the just financial statements which shows the past histories?
So whenever required, the analysts do make an attempt to go to plant visits, meet managements. There are several broker conferences where managements come and address in group meetings, where we can ask our own questions if we have any, or just see what the management response is over a period of time, how it has evolved over a period of time when we track the business. So it's not necessary that we have to always go and meet people or always go and see plant. So for example, I would love to go to Google's campus and talk to Sundar Pichai, but it's not required. I can study the business, because there's a lot of public data available about these companies. Plus, you have to track it from a, I would say, lateral point of view. Whether if you're studying Google's advertising business, try and study advertising companies globally and see what is happening there and how the market share is changing. Or if you're studying cloud computing and Amazon is your target research company, then track about what is happening in companies who are using cloud computing services, rather than directly going and meeting Jeff Bezos and asking him kya lagta hai cloud computing. So it's not necessary to always go and meet people and always go and see plants, but wherever required, yes, we do take the effort.
Okay, sir. So I was asking for the the ones who are feasible, especially for the manufacturing, because many times we have seen whatever data that are shown or published, it can be first. So if possible, could you please share one or two examples if you have visited any factory or plants, if possible?
There are too many actually, so there is no point in going in too much depth. But for example, I remember where there was a R&D plant visit for Hero Group. The analyst had visited and seen the plant. So, or whenever there are these analyst meets, companies do invite analysts directly to the manufacturing facility and show them around. That it's a routine thing. So in capital markets, I think wherever there is a healthy investor relations department, they will organize these trips periodically for institutional investors, so that that discussion can happen with the management. They can meet other key employees who are otherwise not part of the public domain and they don't talk, and they will publish this as a recorded video or a transcript on the exchange. So these are routine things that happen.
So to your question
Thank you so
about due diligence, and sometimes the reported data may not tally with the uh, actual going on.
Correct.
So apart from, sometimes plant visit may not disclose everything. So there are today tools available for institutional investors surely, and some even for retail investors, to check things like GST filings, EPFO filings, some of the channel checks and all of that. So a lot of those things get done at our office to identify some of the red flags that may be existing in the thing. About plant visits, so these days a lot of the plants are actually recorded and you can watch them on YouTube. So if you want to see the blast furnace of a steel company, that will be there. If you want to see the grinding unit of a cement company, that will be there to see. So actually going there and seeing it in operation sometimes doesn't add too much in terms of value. So in the larger companies, you know that there is a plant and these many units are getting manufactured. The red flag checking is via some other things, in terms of, are they depositing their statutory dues on time? Are there litigations going on? So there are services which scan the various courts and see if there are any significant litigations against the promoters or against the company or key management personnel and things like that. So we use various tools to do those kind of due diligences.
Thank you, sir. Thank you so much.
Hi. So, if over the long term share prices should should track earnings growth, then do we have a minimum hurdle? What sort of earnings growth are we looking at a stock level and at the portfolio level?
So the investment returns, portfolio returns, can come by way of three sources. One, as you rightly mentioned, is earnings growth. So if a company was earning 100 now and now it's earning 120, then one would expect that stock price would be higher. That could be one source of growth. The second source of investment return is dividends, where the company gives you cash flow saying, for the year we made this much profit and now this much is what we are paying out. So that is the second source of return. And the third source of return is the P rating or derating. So re-rating or derating. So if the price earning multiple goes up, then you earn more than the earnings growth. If the price earning multiple comes down, then you earn less than the earnings growth. So you are right. Over the long term, typically the company stock price will reflect longer term earnings growth. But sometimes you can buy a high growing company and still lose money. We saw the example of, let's say, Infosys, where for 6 years people did not even break even because they overpaid for growth at some point in time. At the same time, sometimes you can get decent returns from even flattish kind of companies. So for example, if a company is paying out dividends at the yield of 15% per annum, and it's a company which will not grow very well, but which will not decline as well. So even in such a case, you can earn a decent rate of return if your buying price is correct. So as such, there's no minimum growth rate that we require from our investee companies. What we try to do is try to figure out what will be the sources of return on this company, and on a total return basis, how much do we expect to make out of this. So again, a random example. Now, we spoke about NMDC and the iron ore company. Now, it's a cyclical company. It's not a long-term compounding growth company, but uh, it's a company at whatever 30,000, 40,000 market cap, and the 20,000 crore asset, which is not being ascribed any value, is being spun off. Now that you are getting for free. So for your holding period, you can earn a decent return even in companies where the long-term compounding is not happening. Thank you.
So, do we have any plans of foraying into AIF space?
So, so for right now, so again, we keep talking about what are the what else can we do, and are there any spaces that we can diversify into and stuff like that. So yes, we do talk about it. Like I said, like this year, there's no plans, or right now there are no plans to start doing anything new right now. But yeah, we do talk about it, and if there is something that we come out with, we'll definitely let everyone know about it, so yeah, talks are it's not even in an advanced talk. It's just like we just started talking about it, just a few of us here, and just thinking about, just brainstorming different ideas what we can do. And as and when that gets a bit gets a bit structured to that, we'll probably come out with something.
Yeah, again, so in the internal discussions that we have had, coming out with the AIF for investing in listed equity does nothing. It's actually a more inefficient way of investing in listed equities. If at all that has to be there, that has to be for a differentiated strategy in terms of either investing in the unlisted space or something like that. So, yeah, for the listed space, mutual funds are more efficient than PMS or the AIF route.
Sir, what is your opinion about current volatility and how much returns we can expect from a flexi cap fund? And according to SEBI guidelines, whatever is there in the flexi cap category, what kind of return we can expect? Secondly, and why the flexi cap category is a popular right now and among us to invest instead of a particular multi cap or other category funds?
Sure, sir. So, firstly, regulation in India about equity products, mutual funds is such that what we are required to communicate is the statutory disclaimer that is there. Mutual fund investments are subject to market risk, and please read the offer documents carefully before investing. We are not allowed to guide on returns at all. It's completely prohibited in terms of how much return FlexiCap will give next 1 year, 3 years, 5 years, anything like that. I'll tell you about equity markets in general, what has been the past returns that have been there, and what generally happens the world over. So, generally, as the person asking the question previously mentioned, that stock prices tend to follow earnings growth or the growth that the company shows. And company profits tend to follow the growth in the economy. So if the economy is growing at 6% or 7%, and if let's say inflation is 5% kind of thing, one can expect in general corporate profits to grow around 12% or thereabouts. And longer term, one would think that equity markets will do something similar if these things happen. So obviously these are not guaranteed return products, and one cannot predict anything. But historically, equities in India, given India in the past had higher inflation, have given somewhere around 15% return per annum. That is in the past. Future, what will be the return? It's not possible to predict, and we are regulatorily prohibited from giving any guidelines.
Thank you.
Thank you.
if I understand correctly, mutual fund, it is mandatory for mutual funds to vote on resolutions at AGM.
Yes.
So does PPS, our mutual fund has a process to decide how to vote on resolution, and what are the parameters is taken into consideration?
Sure. So, resolutions can be of various types. One resolution can be about approving appointment of an independent director. One resolution can be about approving accounts. One kind of resolution can be about approving salary levels of key managerial personnel. Some resolutions can be about approving or a merger or a demerger or things like that. So whenever resolutions are coming up, the custodian of our securities, which is Deutsche Bank, they send us intimation in advance saying these resolutions will be coming up for voting. And how do you want us to vote? So we give them a direction and then they vote on our behalf. For the larger companies in India now, there are shareholder advisory services. So there are two of them, I believe. There is IIAS and there is SES, which have a team of analysts who examine all the resolutions coming up for vote and they give their recommendations. However, their recommendations are not binding on us and not the only criteria. So they say, SES, I believe, sends recommendations to us, which is examined by the analyst at PPFAS who covers that company. They will also look at their own independent opinion. Most of the times there's concurrence between our opinion and the opinion of the advisory service, in which case we go ahead with that. If we have a difference of opinion, then the analyst will write a note to me via email saying this is what is the recommendation, this is what I think we should do, and they put it up for me, and then we discuss it and we decide what we are going to do and we vote accordingly. Those voting decisions are displayed by us on our website, so people can not the decision process but the actual votes that we cast, those are displayed on our website.
Thank you so much.
Thank you. Yes, please.
My question is regarding real estate investment trust. How do you see them performing when majority of the tenants are in countries where there is recession, cost cutting happening, they are downsizing employees, plus there's an increasing interest rate scenario because it's a part of the conservative hybrid fund.
So you are asking about REITs or real estate as a sector?
REITs.
Okay, REITs. Sure. So the REITs that we have invested in are REITs which own commercial property. These are not houses. These are, and again, the REITs that we invest in have limited amount of borrowing. They are not very, very leveraged entities. So they are not directly linked with the EMI cycle and people losing jobs and not going to office and things like that directly. Not buying a house in that sense. What they depend on is the occupancy, or how many employers are wanting to sign up office space for leasing, at what rate are they willing to sign up. Whatever income that the REITs get, they distribute to most of it, more than 90% of it to unit holders on a quarterly basis. Given the business environment that is there, a select group of tech companies are having some downsizing in the US. At the same time, some of the people that we know in the tech space, they made a very interesting point, saying in this cost-cutting environment, and especially after COVID, in the remote working environment, where people figured out that it didn't matter whether the person was sitting next to you or sitting maybe hundreds of kilometers away, as long as the work got done. So a lot of people started employing people remotely, so in distant geographies. So people from developed countries would have developers sitting in a country like India and stuff like that. that is one way of cost cutting. Cutting out a developed country employee and doing that work in a low cost country like India. So, Mr. Manish Sabarwal, the person who runs the labor outsourcing company, he's been giving interviews. He's spoken about this. He has his ear to the ground. A lot of people are setting up captive centers here or contracting out work here. The other thing is, when we bought the REITs a year or more back, at that time the feeling was that everything will be work from home now. People will never go back to office. That has not turned out to be true because of problems like one employee working in multiple organizations, data security, or whether people are actually putting their full effort, or whether the collaboration is actually happening or not. So, a few trends. Captive centers are coming to India. In India, overall, from the commentary that we have seen in the quarterly results of REITs, sign-ups have been reasonably strong. People have not been giving up their lease promises, and periodic rent escalations are coming in. So overall, the environment is okay. One thing definitely has happened. So when we had bought REITs initially, the yield on REITs was higher than debt securities that we were getting. Right now, debt securities are yielding a bit more than REITs that we own. Yeah, but at the same time, debt does not have any growth in REITs because of additional lease signing and rent escalations. You have some element of growth, but we are not unduly worried about that space as such. Housing will be affected because of increased EMIs and all. REITs are not directly linked to housing per se.
Just in addition to it, have you considered any InvITs which are listed right now?
So REITs plus InvITs have a limit of 10% overall. Between the two, I think REITs are at a more attractive place, but we do track InvITs as well. And if we find something attractive, we'll have that appear in the portfolio as well. Thanks.
So, firstly, really appreciate the presentation and the questions for which you have answered very perfectly. So, my question is, are we into securities lending for the stocks which we hold in our portfolio? Firstly,
It's allowed as per law. We haven't done it so far.
secondly, sir, if you see USD INR has depreciated over the period of time, maybe due to dominance of US or whatever may be the reasons. So, is it mandatory as per regulations to hedge the foreign currency what we buy?
Yeah.
Because if you see the returns over the foreign stocks plus the appreciation in the dollar will more
I'll answer
benefit.
that. I'll answer that, sir. So it's not mandatory as per law. We hedge it. When we hedge it, we get a additional return on hedging. So let's say if spot dollar rupee is 83, then 1 year dollar rupee may be 86. I'm just giving random number. I don't have the exact numbers right now. But we get an additional return even by hedging. So what we would have got by rupee depreciation, we end up getting by hedging.
So one last question. So since IFSC has started opting in the US stocks in India itself,
We are not allowed to remit money outside. So that route is not available, sir.
Okay. Thank you, sir.
Thank you. We'll take last two questions. Two people are at the mics. We'll take last two questions and we'll stop.
Yeah, we'll have to empty the hall at 6. So that's
Thank you, sir, for the opportunity to ask question. The question is related to AUM affecting your portfolio stock picking. As we are now multiples of what we were 5 years back, 1% position 5 years back is much higher as of today. Has this affected our watch list or has it reduced our universe? Are we going to become like a generic large cap? And what will be the future?
Sure. Has it affected our watch list? Yes. So we cannot buy a 50, 60 crore market cap company or a 100 crore market cap company. Very small companies are out. Do we become a generic large cap fund? Answer is no. So 26,000 crore AUM may seem very large, but like the largest fund house in India is 6 lakh crores. And again, mutual funds are not the only players. There are insurance companies, FPIs and all. So when we are growing, India is growing simultaneously. The overall market is also growing. Newer companies are getting listed. So we have plenty of space in the mid cap space, in the larger small cap space. Micro caps, nano caps are definitely out. But larger mid caps and larger small caps, we can. So all mid caps plus larger small caps, we can invest in.
As the AUM further grows, will this affect our ability to pick
We'll
stocks?
see. We are hoping that our AUM and will grow and market will also grow. So that problem doesn't come. But we'll see. Thank you so much. Yes, please.
Hi, my question is more from a macro point of view. Do we, as a fund house, expect recession to hit us in a year or two? And if yes, then is it safe to expect that our cash balance in the flexi cap fund will keep on increasing month on month? And if no, then vice versa, then reducing of the cash balance.
Yeah. I'll split the question in two parts. Second part about cash balance. Cash balance will get reduced as and when we get opportunities. So if we find one stock where we get conviction and we buy that stock to the extent of 5%, a 12% cash position will in a short span go to 7% or lower. So cash is residual. So as and when we get something to deploy, we'll exhaust that. That has nothing to do with boom, recession or anything like that. Do we expect recession? I don't know. What I do think we know is that someday in the future, electric vehicles will be bigger, fossil fuels will be lower, people will stream content instead of watching linear TV, AI will play a bigger role. Instead of people having servers on premise, people will go to cloud computing. Private sector banks will continue to grow deposits and lending because as economy grows, they will. So we are investing based on some of the longer term trends that are there in the way people behave and in the way economy pans out. Quarterly GDP growth, will there be recession, no recession? We don't place too much attention on that. Thank you so much. Thank you everyone for the wonderful set of questions and for taking the time out. Thank you.
Thank you everyone.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.